Good evening, guys. Please confirm, is the audio video clear? Shall we begin? Yes. So are you ready? Another evening full of learning. Yes, let's begin. Let's make the most of the next 4 hours, guys. Today, our target is going to be capital gains. Yesterday, PGBP, I think we did really well. I think we were able to do a very good job yesterday in revising all the provisions. So same way, let's try doing something equally good even today in capital gains, and let's ace the provisions. Let's begin. I'll start off with the very basic concepts. First of all, tell me, what is the charging section? For capital gains, the charging section is section 45, right? And what does section 45 say? Section 45 says, what are we transferring? What are we transferring? There should be a capital asset, and that capital asset we should be transferring. That capital asset we should be transferring when? That capital asset we should be transferring in the previous year. Right? Now, because of the transfer of this capital asset in the previous year, because of this transfer, whatever capital gains arises, that capital gains will be taxed. That is basic section 45, right? So charging section, remember section 45, capital asset is being transferred in the previous year. Because of this transfer, whatever gains arise, that will be taxed in the previous year. Okay, now let us go into the definition of capital asset. We'll have to understand capital asset and we'll have to understand transfer. So what exactly do you mean by capital asset? Instead of trying to understand what is capital asset, let us try to understand what is not capital asset. All right. Number one, you keep telling me, okay, is stock in trade going to be capital asset? No, stock in trade is not capital asset. Then agricultural land. When I talk about agricultural land, if I talk about rural agricultural land, will that be considered as capital asset? No. But urban agricultural land? Yes. Urban agricultural land will be considered as capital asset. Then, in case I have any personal effects, what are personal effects? Personal effects are those assets which fulfill two conditions. Condition number one, they should be movable assets. And condition number two, they should be used for personal purposes, right? Movable assets which are used for personal purposes. For example, mobile phone, watch, it comes under personal effects. Personal effects, will they be considered as capital assets? No. Now, personal effects, I can discuss this personal effects part into two categories. Generally, personal effects are not capital asset, but then you do have some exceptions. What are the exceptions? Do you recall? Jewelry is actually personal effect, but it will be considered as capital asset. Then what else? Archaeological collections, then any drawings, any paintings, any sculptures, or any work of art. Drawings, paintings, sculptures, and work of art, all of these will be considered as capital asset or not capital asset? All of these will be considered as capital asset. Okay, so number one, we said stock in trade, not a capital asset. Agricultural land, if it is rural agricultural land, not a capital asset, but if it is urban agricultural land, it will be capital asset. Personal effects are those movable assets which are used for personal purposes. These movable assets which are used for personal purposes, generally they are not capital assets, but these will be considered as capital assets. Jewelry, archaeological collections, drawings, paintings, sculptures, works of art, no doubt they are personal effect, but they will be considered as capital asset. Anjana is asking us about immovable property. Immovable property will be capital asset. Immovable property does not fit into personal effects because personal effects are only and only movable assets. Okay, then tell me, we have some special bonds. Do you recall any bonds which are not considered as capital asset? Number one, we have 6.5% gold bonds. We have 7% gold bonds. The 6.5%, 7% gold bonds, they are not considered as capital asset. Then what about special bearer bonds? Very good, guys. Special bearer bonds also are not considered as capital asset. Then one more, we have national defense bonds. National defense bonds also not considered as capital asset. And then gold deposit bonds also not considered as capital assets. So what are capital assets then? Out of all these examples we've seen, urban agricultural land will enter into capital asset, and all of these will also enter into capital asset. But remember, these are not the only examples of capital asset. There are many more examples of capital asset. For example, shares, debentures, houses, land. So many examples of capital asset. Our focus here was on understanding what is not capital asset. Okay, stock in trade, not capital asset. Rural agricultural land, not capital asset. Personal effects, not capital asset. 6.5%, 7% gold bonds, special bearer bonds, national defense bonds, gold deposit bonds, not a capital asset. These bonds, generally we don't see them in descriptive questions. At the maximum, you might see them in your MCQs. All right, are we clear with this discussion, guys? So this is about our discussion regarding capital asset. Now coming to the next discussion, let us go a little bit more deeper into capital asset. Capital asset can be of two types, guys. What are the two types of capital asset? We can have either short-term capital asset or we will have long-term capital asset. Short-term or long-term, it all depends upon what? It all depends upon the period of holding. Now, what are the three possible periods of holding? Period of holding can either be 12 months or it can be 24 months or it can be 36 months, right? When do you say 12 months? 12 months applies to which assets? 12 months applies, number one, to listed securities. We are not saying listed shares. We are saying listed securities. Then units of UTI. Then units of equity oriented mutual fund. And lastly, zero coupon bonds. Now see, securities should be listed. What about these three? These three may be listed, they may be unlisted. It does not matter. So, right, are we following, guys? When do you apply the 12 months criteria for listed security? Listed or unlisted units of UTI, listed or unlisted units of equity oriented mutual fund, listed or unlisted zero coupon bonds. Then, when do you apply the 24 months criteria? For how many assets? Only for two assets. Number one, unlisted shares. Unlisted shares, guys, not unlisted securities, unlisted shares. And number two, what else? Immovable property. For these two assets, the relevant period of holding is 24 months. Now tell me, when do you apply 36 months criteria? For everything else, for all other capital assets, you apply 36 months criteria. Can you give me some examples of capital assets for which you apply 36 months criteria? The most common examples. Number one, unlisted debentures. Very good. Then number two, even jewelry will come under 36 months, guys. Right? Unlisted, see, all unlisted securities will not come under 36 months. Unlisted shares will go under 24 months. Only unlisted debentures will come under 36 months, right? Because unlisted shares are covered under 24 months. We do not say unlisted security. By the way, tell me, unlisted preference shares, which category? Unlisted preference shares. That will come under the 24 months category. No, Nihal, 24 months. Because unlisted shares will include both equity and preference. Okay, so unlisted preference shares, 24 months category. Then one more point, units of debt-oriented mutual fund. Even that will come under 36 months because only equity-oriented mutual funds we are covering. So debt-oriented mutual fund will come under 36 months. Are we crystal clear until here, guys? Yes. So can we have a quick revision of the concepts we've learned until here? Come on, guys. Charging section number 45. What does the charging section say? What are we transferring? We're transferring a capital asset. When are we transferring? We're transferring in the previous year. So we're transferring a capital asset in the previous year, and because of that, we're earning capital gains that will be taxed. Then we learned what is capital asset. Actually, we learned what is not capital asset. So what is not capital asset? Number one, stock in trade. Number two, rural agricultural land. Number three, personal effects. And number four, some special bonds. Under personal effects, we said personal effects are those movable assets which we use for our personal purposes. Again, guys, what is personal effects? Personal effects are those movable assets which I use for my personal purposes. But then we have these movable assets which are used for personal purposes, but they are not considered as personal effects. They are considered as capital asset. Jewelry, archaeological collections, drawings, paintings, sculptures, work of art. Tell me the 6 points again. Jewelry, archaeological collections, drawings, paintings, sculptures, work of art. These 6 points, they are actually movable assets. They are actually used for personal purposes, but they are considered as capital asset. Then we said capital asset may be short-term or long-term, depends upon the period of holding. What are the relevant period of holding numbers? We said 12 months, 24 months, and 36 months. 12 months applies for listed securities. listed or unlisted units of UTI, listed or unlisted units of equity-oriented mutual fund, listed or unlisted zero coupon bonds. Then when do you apply 24 months criteria? Unlisted shares and immovable property. Then do you apply 36 months criteria? All other assets. Now, let's go a little bit more deeper. You tell me, less than 12 months, less than 24 months, less than 36 months. Period of holding is less than 12, 24, 36. Short term or long term? It's going to be short term capital asset. Okay. Equal to 12 months, equal to 24 months, equal to 36 months. Long term or short term? Even this will be short term, because when is it long term? Only if it is more than 12 months, more than 24 months, or more than 36 months. Only if it is more than, only then we call it long-term capital asset. Now your understanding is 100% complete. Okay, so now listen guys, we learned about what is capital asset, we learned about when exactly do we charge capital gains, and we've spoken about the different kinds of capital asset. Now let us focus on transfer. What exactly do you mean by transfer? Listen to me. Our next discussion, transfer. Under Income Tax Act, this definition of transfer first of all is given where? It is given in which section? Section 2 clause 47. Right? Now, section 2 clause 47 defines transfer, and the definition of transfer is very, very wide in Income Tax Act. What does it include? It not only includes sale, it also includes exchange. It also includes relinquishment. What is relinquishment? Relinquishment of asset. Relinquishment means what? Giving up the asset. For example, the company gave me rights shares. I gave up the right to buy rights shares to another person. I renounced the right in favor of somebody else. That is relinquishment of asset. Then it also includes extinguishment. What is extinguishment? Extinguishment means destroyed. I had an asset. On this asset, I had taken fire insurance policy. There was a fire. Asset got destroyed. Insurance company gave me money. My asset got destroyed. My asset got extinguished. But still, this will be considered as transfer. It will be as if I have transferred my asset to the insurance company, and insurance company is giving me compensation. Are you following? That is extinguishment. Relinquishment. What is relinquishment? Relinquishment is giving up. What is the best example of relinquishment, guys? Relinquishment best example is renunciation of right. When I renounce my right to buy rights shares in favor of anybody else. What is extinguishment? Extinguishment is nothing but destruction. The best example of extinguishment is insurance compensation cases where my asset gets destroyed because of fire, but insurance company gives me money. It is as if I have transferred my asset to the insurance company and they are giving me consideration. Then in Sale of Goods Act, CA Foundation, you must have learned transfer is voluntary. Yes, but under Income Tax Act, transfer not necessary, it must be voluntary. It also includes compulsory acquisition. What is compulsory acquisition? Who is compulsorily acquiring my property? The government. The central government or the state government is compulsorily acquiring my property. At that time, can I say, no, my father's property, special property, I want to keep the property? Can I say that? No, compulsorily they will take away my property. Compulsory acquisition of my property. Then, in case I have a capital asset and this capital asset got converted into stock in trade, this conversion itself amounts to transfer. We don't have to wait for the sale of stock in trade. Conversion of capital asset into stock in trade, the conversion itself amounts to transfer. Okay, then number 7. Number 7, in case we have zero coupon bonds are getting matured, or zero coupon bonds are getting redeemed. The redemption and maturity of zero coupon bonds, this itself is considered as transfer. All right, and lastly, section 53A of TOPA. What is 53A of TOPA? You make sure you remember. Yesterday we discussed this. In PGBP discussion, we discussed this. What is 53A of TOPA? Do you recall part performance? Amazing, guys. Part performance, perfect answer. The buyer has what? The buyer has possession of the goods. Okay, the buyer has possession of the property. 53A of TOPA is applicable only to immovable property. Okay, the buyer has possession of the property, and the buyer has either paid the consideration or the buyer is willing to pay the consideration, and there is a written agreement between the buyer and the seller. If all these conditions are fulfilled, we will assume as if the seller has transferred the property to the buyer, even though the property papers are still in whose name? Seller's name. Even though registration of the property is not completed yet, even though as per law the seller is still the legal owner of the property, but then as soon as all these conditions are fulfilled, we will treat as if the seller has transferred the property to the buyer. Okay, that is 53A of TOPA. So in all these cases, we call this as transfer. What is transfer, guys? Come on, once again quickly. What does transfer include? Transfer definition is given in section 2 clause 47. What are the definitions? What are the section numbers we've seen until now in capital gains? What was the charging section? Tell me. Charging section. Charging section 45. Then a capital asset. Capital asset, I did not tell you the section number. Capital asset, what's the section number? Anybody? Section 2 clause 14. Very good, guys. Capital asset section 2 clause 14. And then now we learned about transfer section 2 clause 47. All these points are included under transfer. What are the points? Sale, exchange, relinquishment of asset, extinguishment of right, compulsory acquisition, conversion of capital asset into stock in trade, maturity or redemption of zero coupon bonds, and section 53A of TOPA. 53A of TOPA, you understood? Yes, we did not do the registration of the property in the name of the buyer till now. Property is still in the name of the seller only, but the seller has given possession of the property to the buyer. The buyer has either paid the consideration or he is willing to pay the consideration, and there is a written agreement between the buyer and the seller, just that registration has not been completed till now. If all these conditions are fulfilled, we will treat as if the seller has transferred the property to the buyer. All right, shall I take you to the next discussion? This was our third discussion. Now listen to the fourth concept, guys, the computation section. How do you compute capital gains? Computation of capital gains is given in section 48. Section 48 tells us the manner, the mechanism, how are we going to compute capital gains. They say we start with full value consideration. From this, what do we subtract? From this, we subtract expenses on transfer, and the net number is called net consideration. From this, we subtract cost of acquisition. From this, we also subtract cost of improvement, and my net number will be capital gains. This is the basic mechanism in which we compute capital gains, guys. Right? Now, in case I'm talking about cost of acquisition and cost of improvement, if it is a long-term capital asset, then what will I do? If it's a long-term capital asset, I will index the cost of acquisition and cost of improvement. How do I index it? What's the formula? For example, if I'm indexing cost of acquisition into CII of the year of transfer divided by CII of the year of acquisition, right? If I'm talking about long-term capital asset, how do I index a long-term capital asset, guys? Cost of acquisition into CII of the year of transfer by CII of the year of acquisition. If I'm talking about cost of improvement, how do I index cost of improvement? Cost of improvement into CII of the year of transfer divided by CII of what? Divided by CII of the year of improvement. Okay, but then even though it is a long-term capital asset, we have some long-term capital assets for which we do not provide any indexation benefit. Generally, long-term capital asset means cost of acquisition and cost of improvement will be indexed. But we have some exceptional cases. In those exceptional cases, even though it is a long-term capital asset, still no indexation. What are those exceptions? Number one, bonds. Number 2, debentures. Number 3, depreciable assets. If you do WDV, the depreciable assets, WDV depreciable assets, we don't even care about period of holding. We straight away call it what? Short-term capital gains or short-term capital loss. No question of indexation and all. Then number 4, slump sale. Then number 5, section 112A cases. Slump sale, 112A cases and all we will discuss. Then the last point, in case the capital asset is unlisted security. And who is my assessee? My assessee is a non-resident. Unlisted securities of which company? Unlisted securities of Indian company. Assessee is a non-resident. He had acquired these unlisted securities using foreign currency. So in all these cases, even though it is a long-term capital asset, I will not index. But guys, we have one more exception. If I'm talking about bonds generally no indexation, but we have 2 bonds for which indexation is allowed. Which 2 bonds? Number 1, capital index bonds, and number 2, sovereign gold bonds. All right, guys, come on, one quick revision. Sit up straight and listen carefully. What are the rules and regulations about indexation? Generally, if my capital asset happens to be a long-term capital asset, when do you say long-term capital asset? If the period of holding is more than 12, 24, 36, it becomes long-term capital asset. Once it becomes a long-term capital asset, then what do? I index the cost of acquisition and I index the cost of improvement. Now, when I do indexation, even though it is a long-term capital asset, I will not do indexation if the capital asset happens to be bonds, debentures, depreciable assets, WDV depreciable assets, slump sale, section 112 cases. What was the last point? In case the capital asset happens to be unlisted securities belonging to whom? Unlisted securities belonging to Indian companies. Who is the assessee? Owned by whom? Non-resident. Long back when the non-resident had purchased these securities, how did he purchase them? He purchased them using foreign currency. These assets, even though they are long-term, still no indexation benefit. Then we learned that bonds, if they are capital index bonds and if they are sovereign gold bonds, even though they are bonds, I will give them indexation benefit. So general bonds, what will you say? Indexation? No, no indexation. But capital index bonds and sovereign gold bonds, even though they are bonds, still I will index the cost of acquisition for them. Answer my question. Preference shares, can we index them? If they are long term, preference shares, can we index them? Can we index their cost of acquisition? Of course, yes. Preference shares is not covered in this list. Preference shares we can index. Debentures we never index. Okay, now let us talk a little bit about this full value consideration number. Now you tell me whether this full value consideration is adequate, whether it is inadequate. Does it make a difference to us? No, adequate or inadequate is irrelevant. But yes, it will be relevant in two sections. In which two sections do we bother about adequate and inadequate full value consideration? Section 50C and section 50CA. In these two sections, we compare the consideration with the SDV number, we compare the consideration with the FMV number, and if consideration is less than SDV, less than FMV, then we ignore consideration, we take SDV number and we take the FMV number. Right? So generally adequate, inadequate and all we don't bother, but only in 50C and 50CA, only in these two places we bother. Then answer my next question. This consideration, did you receive or did you not receive until now? Is this going to be relevant for us? Whether we received it, whether we did not receive it till now, even that will be irrelevant. See, we don't wait for consideration to be received. When do we tax the capital gains? Do we tax the capital gains in the year of receipt of consideration? No, we tax the capital gains in the previous year of transfer. See, there are some exceptional cases, okay? Those exceptional cases we will see separately. Right now, general discussion we're doing. Whether we received it, whether we did not receive it, doesn't matter. When do we tax the capital gains generally? We tax the capital gains in the previous year of transfer. We generally tax the capital gains in the previous year of transfer and we don't wait for the receipt of consideration. Whether we've received the consideration, whether we've not received the consideration, it does not even matter. Then tell me, can this consideration be in kind? Yes, it can be in kind, it can be in cash, it does not matter. If the consideration is in kind, then how will you compute the consideration? How will you compute FEC? If it is in kind, you will take the FMV number. FMV of what? FMV of what we gave or FMV of what we are receiving? This is consideration. Consideration is always whatever we are receiving in return, right? So in case consideration is in kind, you will take the FMV of whatever we are receiving in return. FEC consideration crystal clear. Now listen, let us talk a little bit about cost of improvement. Cost of improvement, a little bit I want to discuss with you. What is cost of improvement? Cost of improvement is those capital expenses which my assessee is incurring. Because of this capital expense, what is happening? Because of this capital expense, the value of my asset is increasing. Okay, but then this cost of improvement will not include routine expenses. It will not include day-to-day repairs and all. It will include only capital expenses which are going to increase the value of the asset. Now tell me, in case you've incurred any cost of improvement before 1st April 2001, do you consider? No. Any cost of improvement incurred before 1st April 2001, ignore. Any cost of improvement incurred before 1st April 2001, we ignore. right? Then in case my capital asset happens to be goodwill, in case my capital asset happens to be goodwill, whether goodwill of business, whether goodwill of profession, do you consider cost of improvement? No. If my capital asset is goodwill of business or profession, we ignore the cost of improvement. Okay, are all these points clear? In this one slide, in this one page itself, a lot of things we have learned. Shall we take a minute and revise all these points once? Yes, listen. We learned about the computation section. Computation section is with section number? Section number 48. Section 45, charging section. Section 2, clause 14, capital asset definition. 2, clause 47, transfer definition. Section 48, computation section. We spoke about indexation first. We said in case my capital asset happens to be a long-term capital asset, then I will index the cost of acquisition, I will index the cost of improvement. But then we said if my long-term capital asset happens to be these 6 cases, even though it is long-term capital asset, no indexation. What are these assets? Bonds, debentures, WDV depreciable assets, slump sale, section 112A cases, and unlisted securities of which company? Of an Indian company. Who is the assessee? Non-resident. Long back, how did he purchase? Using foreign currency. Okay, these assets, even though long term, no indexation. Then we learned in case I'm talking about bonds, if these bonds happen to be capital index bonds or sovereign gold bonds, even though they are bonds, I will allow indexation. Okay, then we started discussing about full value consideration. We said full value consideration may be adequate, inadequate, doesn't matter. It matters only in 50C and 50CA. Then we learned this full value consideration, whether received, not received, doesn't matter. We tax the capital gains in the year of transfer and not in the year of received. There are some exceptions, we'll see later. Then we learned full value consideration we may receive in cash or we may receive in kind. When we receive in kind, we will see what is the FMV of the asset which we are receiving, not FMV of what we are giving, FMV of what we are receiving. That's going to be the full value consideration number. Then we started talking about cost of improvement. Cost of improvement, we said these are capital expenses which increase the value of the asset, but they are not day-to-day routine expenses and all, not day-to-day repairs and all. In case I incurred any cost of improvement, this was an important point, guys. In case I incurred any cost of improvement before 1st April 2001, what do? I ignore it. This is one point which a lot of students forget because this point gets lost amongst all the important points in the capital gains chapter. Remember this, any cost of improvement incurred before 1st April 2001, simply ignore. Okay guys, now listen to the next discussion. Till here, whatever we learned was like basic discussion under capital gains. Alright, now listen to my next discussion. My next discussion is going to be some special situations. Who's this? There's somebody who's messaging with the name Poco M4 Pro 5G. On 1st April 2001, you're asking me what is 1st April 2001. I'm guessing you're watching the session regarding capital gains for the very first time. Am I right? Because a student who has already done capital gains before will not ask that question. So I don't think you will be able to follow the session because the session is a revision session for those who've already discussed, who've already learned this chapter. Okay, try your best to grasp as much as you can, but I'm very sorry, I don't think that this session will be making much sense to you because I'm going super fast speed and I'm discussing this session with the perspective of revision. All right, so that's why. All right, now listen to the next discussion, guys. We're going to be learning some special situations. In these special situations, we will take one concept and we will go in depth. All right, several special situations we will be seeing. Talking about my first special situation. What if the date of acquisition is before 1st April 2001? Tell me, guys, if the date of acquisition is before 1st April 2001, what do you do? If the date of acquisition is before 1st April 2001, you will see what is a capital asset. Is the capital asset immovable property or is the capital asset any other capital asset? If it is any other capital asset, very simple. What are the two things you will compare? You will see the actual cost of acquisition and you will compare it with FMV on 1st April 2001, and out of these two numbers you will pick whichever is higher. Perfect, guys. In case my capital asset is any other immovable property, then what will you do? In that case, you will see the actual cost of acquisition, all right, and you will compare it with FMV on 1st April 2001 and SDV on 1st April 2001. Out of these two numbers, you will pick whichever is lesser. Okay. And out of these two numbers, you will pick whichever is higher. All right, guys, listen, many times what happens is, as a shortcut, we straight away take the FMV number. Never do that. Compare and then pick whichever is higher. All right. So what was my first special situation? What if I acquired the asset before 1st April 2001? Then I will see, is my capital asset an immovable property or is my capital asset any other capital asset? If my capital asset is immovable property, I'll compare the actual cost of acquisition with FMV or SDV, whichever is lesser. And out of these two numbers, I will pick whichever is higher. If it is any other capital asset, I will just compare actual with the FMV number. And out of these two numbers, I will pick whichever is higher. This was my first special situation. Now talking about my second special situation. In my second special situation, I'm going to focus on this concept of liquidation. In case my company gets liquidated, then what are the capital gains implications? Listen extremely carefully, guys. This is going to make a lot of sense to you. Let us say my company is A Limited. Okay, and let us say this person, Mr. Red, he is a shareholder of A Limited. Okay, and this company A Limited is going into liquidation. Liquidation means what? It is winding up. What is liquidation? Liquidation is that step in which the company sells away its assets, gets money, pays off the creditors, and what does the company do with the balance money? Company sold away assets. Okay, with this assets, it got money. With that money, the company will pay off liabilities, right? Even after paying off liabilities, company is still left with money. What will you call this? You will call this as surplus assets, right? And what does the company do with the surplus assets? These surplus assets, the company distributes to whom? These surplus assets, the company distributes to shareholders. This is what happens generally. So Mr. Red is a shareholder of the company and this company is going into liquidation. Company has sold assets, company has paid off liabilities, company is still left with surplus assets. Those surplus assets, the company is distributing to shareholders. When the company is distributing surplus assets to shareholders, it may be in cash also, it may be in kind also. Do you agree with me? These surplus assets may be in cash also, it may be in kind also. Right? Now, you tell me, in the hands of the company, any tax implication? In the hands of the company, no tax implication at all. But in the hands of the shareholder, will we have tax implication? Yes, in the hands of the shareholder, we will calculate capital gains. In the hands of the shareholder, you will calculate as if the shareholder has sold his shares to the company. You will treat as if the shareholder is selling his shares to the company and in return, company is giving him money. You will treat it like that. Okay, so in the hands of the shareholder, what will the capital asset be? Capital asset will be shares of the company. Then what will the period of holding be? Period of holding will start from the date of acquisition, but period of holding will end when? What will the date of transfer be? Will the date of transfer be the date of liquidation, or will the date of transfer be the date on which the shareholder is getting all this from the company? Tell me, guys. The date of transfer will be what? Will it be the date of liquidation, or will it be the date on which the shareholder is getting all this from the company? It will be the date of liquidation. So the period of holding will end on the date of liquidation. So do you agree that I can say date of liquidation is date of transfer, guys? Yes. Then what will the full value consideration be? In such cases, full value consideration for Mr. Red, how will he calculate? He will see full value consideration is always whatever we are receiving. What are we receiving? We are receiving cash. Then we are receiving some assets in kind. Whatever assets we are receiving in kind. I told you, whenever full value consideration is in kind, how do you calculate the number? You will take the FMV. You will take FMV of assets received, and from this, what will you subtract? From this, you will subtract 222C dividend. You know 222C dividend, right? 222C dividend is nothing but whatever the company is distributing to the shareholders upon liquidation. I'll repeat again, whatever the company is distributing to the shares, to the shareholders upon liquidation, to the extent of the company's accumulated profits will be 222C dividend. Whatever the company is distributing to the shareholders upon liquidation, to the extent of company's accumulated profits, whether capitalized or not, will be 222C dividend. So this is going to be the full value consideration. Now tell me, this FMV of assets you will take on which date? FMV you will take on the date of liquidation or on the date on which company is giving the assets to the shareholder. You will not take on the date of liquidation. You will take the FMV on the date of, it's called date of distribution. You will see when is the company giving the assets to the shareholder, that is the date of distribution. On that date, you will take the FMV. Now listen, what if my assessee sells this asset later? What if my assessee transfers this asset later? When he transfers this asset later, at that time, what will be the cost of acquisition of this asset, guys? What will the cost of acquisition of this asset be? Whatever was the FMV on the date of distribution, whatever number you had included in full value consideration earlier, that same number, that same FMV which you had included in full value consideration earlier, that same FMV will now be a part of cost of acquisition. The same FMV which was a part of full value consideration earlier, that same FMV number will now be cost of acquisition. All right, now listen to one last point relating to liquidation. Extremely important point, guys. Listen, generally, when do you tax the capital gains? Previous year of transfer. In the previous year of transfer itself, you tax the capital gains, right? Now you tell me, in liquidation cases, what is the previous year of transfer? In liquidation cases, when is the transfer happening? The transfer is happening on the date of liquidation. But when do you tax the capital gains? When do you tax the capital gains? You will tax the capital gains in the previous year of distribution. So previous year of taxation and previous year of transfer will not be the same. Generally, previous year of transfer only we tax the capital gains, but in liquidation cases, the transfer will happen in the year of liquidation, but we will tax the capital gains only in the year of distribution. This was our entire discussion regarding liquidation. Okay, one quick revision, guys. Shall we rediscuss? So we're learning the special situations. Our first special situation was, what if we had acquired the asset before 1st April 2001? If we had acquired the asset before 1st April 2001, then you will see what kind of an asset is it? Is it an immovable property or is it any other asset? If it is immovable property, actual cost of acquisition or FMV SDV on 1st April 2001, whichever is lesser, out of these two numbers, whichever is higher. Why higher, guys? Why higher? Because cost of acquisition we are computing. Cost of acquisition, you're computing the cost of acquisition. Which is better? Higher the cost better or lower the cost better? Higher the cost better, right? Higher the cost, lesser will be the capital gains. Lesser the capital gains, lesser will be your tax. Right? So that's why we pick whichever is higher. In case it is any other capital asset, how will you calculate the actual cost of acquisition or FMV on 1st April 2001, whichever is higher. Okay, then we started talking about liquidation. Under liquidation, we said, first of all, we said in the hands of the company, there will be no tax implications, but for the shareholder, there will be capital gains. This was the first point. For this shareholder, when I calculate capital gains, his capital asset being transferred will be the shares which he is transferring. Then when will his period of holding end? What will his date of transfer be? His date of transfer will be the date of liquidation. The date of transfer will be the date of liquidation. Guys, I hope wherever you're sitting, you're repeating along with me. You need to get all these points registered in your memory, right? So keep repeating along with me. Okay, so date of transfer will be the date of liquidation. Then we learned how to compute full value consideration. Full value consideration, what will you do over here? Full value consideration, you will see what is the cash we are receiving from the company, what are the assets we are receiving from the company. Whatever assets we receive from the company, those assets FMV you will take. But FMV you will take on which date? FMV you will take on the date of distribution. From this we will subtract 222C dividend. The 222C dividend part, did you all understand? Yes, we will see what is the company distributing to the shareholders upon liquidation to the extent of accumulated profits, whether capitalized or not. To that extent, it will be considered as 222C dividend. But why are we subtracting it? Why are we subtracting it? Because this is going to be taxed where? This 222C dividend will be taxed under the head IFOS, right? So that is why we can't tax it again under capital gains. That is why we subtract it from full value consideration we subtracted in the capital gains calculation. All right, then we learned this asset which we are receiving from the company, the same asset if we sell later, then what will the cost of acquisition be? Whatever FMV number which was included in the FVC earlier, that same FMV number will be treated as cost of acquisition when I sell away the asset later. Then we learned generally previous year of transfer is generally whenever I transfer the asset in that year itself, I tax the capital gains also. But we do have some exceptional cases. In liquidation cases, transfer is happening in the year of liquidation, but taxation will happen only in the year in which the company distributes the asset. Perfect understanding. Give me a confirmation. Liquidation part thorough, guys. Yes, just answer one small thing. This 222C part, did you understand? This alone, I'm a little unsure whether you understood or not, because this is an IFOS concept. You've done your revisions, right? 222C part, you all know, right? Fine, perfect. Then listen to the next discussion. My third special situation here. Third special situation, we'll do something easy. Section 49, subsection 1. Section 49, subsection 1 cases is what we will be discussing. Yashwant is asking, will you be doing practical problems? No, Yashwant, the session focuses on just revision of all the provisions. We're going to be revising all the provisions one by one, just like how yesterday we revised PGBP. Same method we're going to be doing today. All right, so talking about section 49, subsection 1, what exactly happens here? We're talking about situations where special situations, special points under 49 subsection 1, where cost of acquisition will be cost to the previous owner. The period of holding will include even the previous owner's period of holding, right? So these are some special situations. Let us see the situations one by one. The first point, let us say there are three people in a story. We have this person, Mr. Red, we have this person, Mr. Blue, and then we have this person, Mr. Green. Okay, this person, Mr. Red, he gifted some jewels to Mr. Blue. Okay, now these jewels Mr. Red had purchased long back. His date of acquisition was, let us say, 1st April 2021. He had purchased them for rupees 60,000. He had purchased them. These jewels he is gifting to Mr. Blue. Let us say he is gifting to Mr. Blue on 1st June 2021. This Mr. Blue is transferring those jewels. He is transferring those jewels to Green, and in return, Green is giving him consideration 1 lakh rupees, let us say. Okay, and let us say Blue had transferred these jewels to Green on 1st of August 2021. This is my story. These are the facts of the case. And let us say Red and Blue are relatives. Let us say Blue is Red's brother. Okay, now let us discuss person by person. Let us talk about Mr. Red first. Mr. Red is gifting the asset. Is gift a transfer? No. Red is gifting the asset to Blue. Is gift a transfer? Gift is not a transfer. You may give the gift to anybody, to relative, to non-relative, to you may give the gift to anybody. Is gift a transfer? Gift will never be considered as transfer. So in the hands of Red, guys, will there be any capital gains tax? No capital gains at all. Okay, now listen to my next person, Mr. Blue. When Mr. Blue is receiving the gift, Mr. Blue is receiving the gift from his brother, IFOS. For him, this gift will go under IFOS, and under IFOS, it will be what? Under IFOS, it will be exempt, right? Under IFOS, it's going to be exempt because gift from relative. Gift from relative, what do? He's getting a gift from his brother. Gift from brother, gift from relative will go under IFOS, and under IFOS, it will be exempt. But guys, Mr. Blue is later selling the asset to Green. So when he is transferring the asset to Green, at this time, what will arise? At this time, capital gains will arise, right? Now, how will you compute this capital gains? To compute this capital gains, what will the period of holding be? Tell me the date. Tell me when will the period of holding start? Blue got the jewels only on 1st June. So will the period of holding start on 1st June? No. 49 subsection 1 will apply. Period of holding will start on 1st April 2021 and it will end when? When is he transferring the jewels? 1st August 2021. Okay, then this is about period of holding. What will his cost of acquisition be? Did Blue actually spend something to acquire the jewels? Nothing. Cost of acquisition will be cost to the previous owner. Cost of acquisition will be 60,000 rupees. Then cost of improvement. Will you include even Red's cost of improvement? Yes, you will include even previous owner's cost of improvement. This was my first case under 49 subsection 1. What was my first case under 49 subsection 1, guys? We are receiving a gift from a relative. We're receiving a gift. We're talking about Mr. Blue. Okay, my assessee, my main person over here is Mr. Blue. When Mr. Blue received the gift was exempt for him. When Mr. Blue, I am Mr. Blue, when I received the gift, it was exempt for me. Now, when I transfer the gift, what will apply? 49 subsection 1. Come on, guys, repeat again along with me. When Mr. Blue received the gift, it was exempt for him. Later, when he transfers the gift, what will apply? 49 subsection 1. One last time. When I received the gift, it was exempt for me. Later, when I transfer the gift, what will apply? 49 subsection 1. Crystal clear? Yes, when I received the gift, it was exempt for me. Later, when I transfer the gift, 49 subsection 1 will apply. Under 49 subsection 1, my cost of acquisition will be cost to the previous owner. My period of holding will start from previous owner's period of holding. Under 49 subsection 1 itself, the second situation I am discussing. In the second situation, what I will do is I will copy paste the same thing so that it gets done faster. In the second situation, this assessee over here is not Mr. Red. Let us say this assessee over here is a HUF. This HUF is acquired some jewels long ago on 1st April 2021, acquired these jewels 60,000 rupees. This HUF is going through a partition. Partition means what? The HUF is getting partitioned. Division is happening. Division of all the assets. HUF, one of the assets was these jewels which it had acquired for 60,000 rupees. Those jewels it is giving to Mr. Blue. Who is Mr. Blue? Mr. Blue is a member of the HUF. Did you understand this? Did you understand my second situation under 49 subsection 1? My first situation was when I received the gift, it was exempt for me. My first situation was when Mr. Blue received the gift, it was exempt for him. In my second situation, what is happening? In my second situation, we're talking about partition of HUF. We're talking about distribution of assets because of partition of HUF. This HUF is getting partitioned, and because of the partition, the HUF is going to divide all the assets. So it's going to divide all the assets to all its members. The jewels it is giving to Blue, who is one of its members. Now you tell me, HUF is giving the jewels to the member upon partition. This distribution, will it be considered as transfer? I'm talking about the HUF's perspective. For the HUF, will this distribution be considered as transfer? No. Always remember, gift is not a transfer. Any distribution of assets by the HUF upon partition is not a transfer. Again, any distribution of assets by the HUF upon transfer, no. Any distribution of assets by the HUF upon partition is not a transfer. Any distribution of assets by a HUF upon partition is not a transfer. So for HUF, will we have capital gains? For HUF, no capital gains. Now let us talk about Mr. Blue. Mr. Blue is receiving the jewels. For Mr. Blue, it's like a gift. Gift from HUF. Gift from HUF. Is it taxable for Mr. Blue? No. Gift from HUF. HUF will become relative. For me, my HUF will be a relative. If I'm a member of a HUF, then for me, that HUF will also be considered as relative. Any gift I receive from HUF is going to be exempt for me. So for Mr. Blue, this assets received will be exempt for Mr. Blue. You tell me, when I received the gift, it was exempt for me. Later, when I transfer the gift, which section will apply? When I received the gift, it was exempt for me. Later, when I transfer the gift, 49 subsection 1 will apply. Cost of acquisition will be previous owner's cost of acquisition. Period of holding will include even previous owner's period of holding. So period of holding will start on 1st April 2021, and cost of acquisition will be cost to HUF, cost to the previous owner. Second situation also fine. Okay, now let me take you to the third situation. Listen to what happens in the third situation. In the third situation, this person, Mr. Red, long ago, he had purchased the jewels on 1st April 2021 for 60,000 rupees. Later, what happened is this Mr. Red, he died. He died on 1st June 2021. Okay, this person, Mr. Blue was Red's son. Mr. Blue was Red's legal representative. And according to Red's will, according to his will, he had left behind a will. Under that will, Red's jewels went to Mr. Blue. Later, Mr. Blue sold those jewels to Mr. Green. Now answer my question. He died and the jewels got transferred from him to Mr. Blue under will. Any transfer of assets under will, will it be considered as transfer? Any transfer of assets under will it be considered as transfer? No. So for it, will you have any capital gains tax? No. So point number 1, gift is not a transfer. Point number 1, gift is not a transfer. Point number 2, distribution of assets by HUF to its members upon partition also not a transfer. Number 3, any transfer under a will also not a transfer. All my first 3 points clear. So for Mr. Red, there will be no capital gains. Now, Mr. Blue, you must have learned under IFOS, whenever you receive anything under a will, taxable or exempt, under 56(2)(10), whenever you receive anything under a will, it will always be exempt, right? So guys, listen, when you received it, it was exempt. So later when you transfer, which section will apply? Section 49 subsection 1. So cost of acquisition will be cost to the previous owner. Period of holding will include even previous owner's period of holding. So my first case was gift cases. My second case was distribution by HUF upon partition. My third case is about transfer of asset under a will. Mr. Red dies, and under his death, because of his death, under his will, his assets go to his legal representative. So any transfer of asset under will not be considered as transfer, first of all. For the recipient, anything received under a will of a deceased person is always exempt under IFOS. When you received, it was exempt. So later when you transfer, 49 subsection 1 applies. Got it? Yes. Now listen to the fourth situation. In the fourth situation, little different thing. Let me change all this. Wait, give me one moment. Listen. We have two people in our story this time. We have a holding company, okay? Then we have, we have a holding company, and then we have an Indian wholly owned subsidiary. We can't talk about jewels, holding company, what jewels? Let us talk about some capital asset, some random capital asset. Okay, this holding company had long ago purchased a capital asset on 1st April 2021 for 60,000 rupees. This holding company transferred this capital asset to wholly owned subsidiary. Not a gift. Let us say wholly owned subsidiary had even given some money. Let us say wholly owned subsidiary had given 70,000 rupees to the holding company for this transfer. Later on, this Indian wholly owned subsidiary is transferring that same capital asset they're transferring on 1st August 2021 to Mr. Green for rupees 1 lakh. Now what will happen? Always remember, whenever holding company transfers any asset to its wholly owned subsidiary, whenever a holding company transfers anything, any capital asset to its Indian wholly owned subsidiary, it will not be considered as transfer. Are you following? Are you registering all this? Yes, any holding company transfers any capital asset. See, listen guys, it is for a consideration. Still, it will not be considered as transfer. Holding company to Indian wholly owned subsidiary will not be considered as transfer. No capital gains. Now, later when this Indian wholly owned subsidiary, when it transfers to Mr. Green, then 49 subsection 1 will apply. Here, no question of gift and all. There is no gift over here. When the wholly owned subsidiary later transfers this asset to Mr. Green, then 49 subsection 1 will apply. The cost of acquisition will be cost to the previous owner. Period of holding will include even previous owner's period of holding. So what is my fourth situation? My fourth situation is holding company to Indian wholly owned subsidiary. All right. In my fourth situation, my holding company is transferring an asset to Indian wholly owned subsidiary. Transfer of asset from holding company to Indian wholly owned subsidiary, even if it is for a consideration, this will not be considered as a transfer and there will be no capital gains. When this Indian wholly owned subsidiary later transfers the same asset to some other person, at that time, there will be capital gains. At that time, you will apply 49 subsection 1. 49 subsection 1, you will take cost to the previous owner and period of holding will include even the previous owner's period of holding. Perfect understanding, guys. Yes, the exact same thing we can talk about ulta also. Yes, this time what will happen? This time who will transfer to whom? This time wholly owned subsidiary will be transferring to Indian holding company. So this time again we will have two people. Who will the two people be? This time my wholly owned subsidiary, will be transferring the asset to Indian holding company. Any transfer from wholly owned subsidiary to Indian holding company will not be considered as transfer. No doubt it is for a consideration. No doubt we're getting some consideration from Indian holding company. Still, wholly owned subsidiary to Indian holding company not considered as transfer. This Indian holding company, later when they transfer the asset, at that time what will you apply? Again you will apply 49 subsection 1, and under 49 subsection 1, cost will be cost to the previous owner, and period of holding will include even the previous owner's period of holding. Even cost of improvement you will include even previous owner's cost of improvement. All right, so what were the cases we've learned, guys? Our first situation was gift. Second situation was partition of HUF. Third situation was transfer under a will. Fourth situation was holding company to Indian wholly owned subsidiary. Fifth situation is wholly owned subsidiary to Indian holding company. Okay, now listen to our next situation, guys. Our sixth situation. Sixth situation is going to be important. Listen carefully. This time, I'll redraw the entire situation once again. We have two companies here. We have A company, A Limited, and then we have B Limited. Okay, and then we have our person, Mr. Green. Okay, this A Limited is going to merge with B Limited. Okay, if it's going to merge with B Limited, A Limited had purchased some assets long ago, date of acquisition 1st April 2021. The cost of acquisition was 60,000, let us say. A Limited had purchased some assets on 1st April 2021. Now, if it merges with B Limited, what will happen to all of A Limited's assets, guys? All of A Limited's assets also will go to B Limited. Yes, let us say the merger happened on 1st June 2021. Now, who has become the owner of the assets? Now, B Limited has become the owner of the assets. A Limited is merging with B Limited. So, A Limited's assets will all get transferred to B Limited. Right? Now, this, will it result into transfer? Will it result into transfer? See, what will you call A Limited? You will call A Limited as amalgamating company. What will you call B Limited? B Limited will be the amalgamated company, right? Always remember, any transfer of asset from amalgamating company to amalgamated company, will it be considered as transfer? It will not be considered as transfer. And in the hands of A Limited, will you have any capital gains? There will be no capital gains. Guys, are you following? Is a revision happening? Are you gaining the confidence? Yes, guys, A Limited is transferring assets to B Limited under a merger. A Limited is transferring the assets to B Limited under a merger. This A Limited is an amalgamating company. This B Limited has to be an Indian company. The amalgamated company has to be an Indian company. Transferred by an amalgamating company to an Indian amalgamated company, this transfer will not be considered as a transfer, and at this stage there will be no capital gains at all. Now, who's become the owner of the assets? Now, B Limited has become the owner of the assets. Let us say this Mr. B Limited transfers the same capital asset to Mr. Green. All right, let us say the transfer happened on 1st August 2017. For a consideration, Green had given rupees 1 lakh to B Limited for this asset. Now, in the hands of B Limited, now capital gains will arise, guys. When capital gains arise, how will you compute? You will apply 49 subsection 1. What will the cost of acquisition be? Cost of acquisition will be cost to the previous owner, 60,000. Period of holding will include even previous owner's period of holding. You will start on 1st April 2021 and you will end on 1st August 2021. All right, so this was my sixth case. My sixth case was targeting amalgamation, merger. A Limited is merging with another Indian company, amalgamating company, merging with another amalgamated company. This amalgamated company has to be an Indian company. Because of the merger, earlier A Limited was the owner of the assets. Now all the assets will get transferred to B Limited, to the Indian amalgamated company. So first of all, transfer of assets by amalgamating company to amalgamated company will not be considered as transfer. In the hands of A Limited, no capital gains. And by the way, for B Limited, will IFOS apply? For B Limited, will there be any taxation under 56.210? No. In 56.210, in the exceptions, you have that list of exceptions, right? Which talks about gift from relative exempt, from HUF exempt, under a will exempt. In that list, one of the points is this also. If any company is receiving any asset under amalgamation, for this company, it's going to be exempt. Under IFOS, it is going to be exempt. It is clearly written in that list of exclusions that under a merger, under an amalgamation, when you receive assets from an amalgamating company, it's going to be exempt under IFOS. This company, when it transfers the asset later, 49 subsection 1 will apply. Cost of acquisition will be cost to the previous owner, and period of holding will include even previous owner's period of holding. Cost of improvement, you will include even previous owner's cost of improvement. But what if the cost of improvement was incurred before 1st April 2001? Will you include that also? You know very well, cost of improvement before 1st April 2001, you do not consider. All right, guys. Now listen to my next situation. Same under 49 subsection 1 only. We are still under 49 subsection 1. Now we are talking about demerger. In demerger, let us say A Limited was having two businesses. A Limited was running paper business also. It was running steel business also. It was becoming very difficult for it to handle two businesses. So what A Limited did is, A Limited decided to demerge. A Limited decided to keep the paper business and the steel business it transferred to B Limited. So A Limited will be called as the demerged company and B Limited will be called as the resulting company. So there is a demerger. Under a demerger, when the demerged company transfers assets to whom? Under the demerger, when the demerged company transfers the assets to Indian resulting company, in the hands of the demerged company, will there be a transfer? No transfer, no capital gains. B Limited is receiving assets from A Limited. For B Limited, will you tax anything under IFOS? Receipt of assets under demerger, will it be taxed under IFOS? No. Under IFOS, company, if you're receiving anything from another company under a merger, or if you're receiving anything from another company under demerger, it will be exempt for you, no IFOS for you. Later, when this B Limited transfers the assets to green, what will happen? Capital gains will arise. 49 subsection 1 we will apply. Cost of acquisition will be cost to the previous owner and period of holding will include even previous owner's period of holding. Crystal clear? Yes, so this was my 7th situation about demerger. This was the last point under 49 subsection 1. Just a moment, guys. Yeah. So what were the situations we learned? What was the first special situation? Our first special situation was, what if we acquired the asset before 1st April 2001? Our second special situation was liquidation. Liquidation, you understood properly? Date of transfer will be the date of liquidation. What will the full value consideration be? Full value consideration will be the cash that we are receiving, FMV of the assets that we are receiving, minus 222C dividend. Why are we minusing 222C dividend? Because this amount we will anyways be taxing under IFOS. Okay, then we learned this asset which we are receiving. Later, if we sell away the asset, then what will the cost of acquisition be? Whatever FMV was included in the FPC earlier, that will be considered as cost of acquisition. Okay, then we learned about 49 subsection 1. Under 49 subsection 1, we said we include cost as previous owner's cost of acquisition. We include previous owner's period of holding. We include even previous owner's cost of improvement. Here, our first point was when I received the gift, it was exempt for me. Later, when I transfer the gift, 49 subsection 1 will apply. Second situation, partition of HUF. HUF got partitioned. Under HUF's partition, I was a member of the HUF. Because HUF got partitioned, HUF distributed assets to all members. Under partition of the HUF, I got an asset. It will be exempt for me. Later, when I transfer the asset, 49 subsection 1 will apply. Then third situation, we learned the will. A person died. Under his will, I received an asset. Later, when I transfer this asset, 49 subsection 1 will apply. Fourth point, we learned holding company to Indian wholly owned subsidiary. Fifth point was wholly owned subsidiary to Indian holding company. Then we learned about amalgamation, and then we learned about demerger. In all these cases that we learned, for the transferor, there was no capital gains. Did you notice that? In all these cases that we learned, for the transferor, there was no capital gains at all. For this person, there will be capital gains when this person transfers the asset later. At that time, 49 subsection 1 will apply. So this was our third special situation about 49 subsection 1. Now listen to my next special situation, guys. We're learning about 49 subsection 4 now. This is extremely important. A lot of times students make a mistake here. Listen carefully. When I received the gift, at that time, it was exempt for me. Later, when I transfer the gift, which section will you apply? 49 subsection 1. Okay. But when I received the gift, it was taxable for me. Later, when I transfer, which section you will apply? 49 subsection 4. This part, if you remember, you're not going to make a mistake. When I received the gift, it was exempt for me. That gift, when I transfer later, 49 subsection 1 will apply. When I received the gift, it was taxable for me. That same gift, when I transfer later, 49 subsection 4 will apply. All right, shall we try to understand 49 subsection 4 now? Yes, listen to me carefully, guys. Again, same three people in our story. Mr. Red, I'll go a little slowly. Try to grasp Mr. Red, Mr. Blue, Mr. Green, three people in our story. Mr. Red, long back on 1st April 2021, he had purchased the asset for rupees 60,000 rupees. This Mr. Red, he gifted this asset to Mr. Blue. Mr. Blue was Red's friend. Okay, this Mr. Blue later transferred that asset. Let us say these assets are jewels. Okay, so later Mr. Blue transferred those jewels to Green. In return, Green gave him consideration of rupees 1 lakh rupees. The gift happened on 1st of June 2021. This transfer from Blue to Green happened on 1st August 2021. One by one. Let us talk about Mr. Red first. For Mr. Red, there's a gift. Will gift be considered as a transfer? Yes or no? Think carefully and give me the answer. Please do not forget that Blue over here is Red's friend. There might be a major learning for many of you here. I want everybody to participate. Tell me, Mr. Red is giving a gift to his friend. This gift, will it be a transfer for Mr. Red? Yes or no? Will this gift be considered as a transfer? Yes or no? No, guys. Gift is never a transfer. Under capital gains, it doesn't matter to whom you're giving the gift. Gift is never a transfer. Whether you're giving the gift to a relative, whether you're giving the gift to a non-relative, whether for this person it is exempt, whether for this person it is taxable, gift is never ever a transfer. Gift is never a transfer. So in the hands of Red, will there be capital gains tax? In the hands of Red, there will be no capital gains tax. Always remember, guys, I'll give you one simple hint at this stage. From the seller's perspective, which head of income will you think about? Listen. You need this sort of clarity. For the seller, when you're thinking about the seller, which head of income will you think about? From the seller's perspective, you will always think about capital gains head. Okay. From the buyer's perspective, which head of income will you think about? Buyer's perspective, you will think about IFOS. Okay. Then employer, which head of income will you think about? Employer, PGBP. PGBP. Employee, which head of income will you think about? You will think about salaries. Have this basic clarity. This itself will be half the job done. Okay, now we are talking about the seller's perspective. When you're thinking about red, in your mind, you should not think that, red's friend, IFOS, gift, taxable. No, we don't care about IFOS. We're talking about the seller's perspective. Which head will we think about? Capital gains. And capital gains says gift is not a transfer. So it doesn't matter to whom I am giving the gift. I am giving the gift. Gift is not a transfer. No capital gains. This first point in your memory, in the mind, registered. No mistake will happen here. Now listen. Coming to the next part. Mr. Blue. Mr. Blue received the gift. Received the gift from a friend. Movable assets. No consideration. FMV more than 50,000. Let us say FMV of the gift, on the date of the gift, FMV was, let us say, 80,000 rupees. So, for Mr. Blue, what will you do? IFOS, how much? 80,000 will be taxable. Do you agree? Mr. Blue is receiving a gift. From Blue's perspective, which head of income will you think about? Blue is getting a gift, guys. From the recipient's perspective, you will think about the IFOS head. He is getting a gift of jewels. Is jewels capital asset? Yes. Why are we thinking about capital asset? Because even in IFOS, the asset which I'm receiving should be a capital asset, right? So are the jewels capital asset? Yes. Then from a friend, FMV is more than 50,000? Yes. All conditions fulfilled. For Blue, IFOS 80,000 will be taxable. Okay. Now later, when Blue sells the asset to Green, let us talk about this. When he sells the asset to Green, capital gains will arise. Yes. Now, when I received the gift, it was exempt for me. This gift, when I sell later, which section will you apply? 49 subsection 1. But here, when I received the gift, it was taxable for me. I am Mr. Blue. When I received the asset, it was taxable for me. IFOS was taxable for me. So later, when I sell the same gift, which section will I apply? I will apply 49 subsection 4. Under 49 subsection 4, do I consider previous owner? I ignore the previous owner. Under 49 subsection 4, I ignore the previous owner. So how will I calculate capital gains? What will my full value consideration be? For how much am I selling? What is my full value consideration? I'm selling for 1 lakh rupees. What will my period of holding be? My period of holding, I will not consider previous owner and all. When did I get the gift? When did I get the asset? When did I become the owner of the asset? 1st June 2021 to 1st August 2021. I will ignore previous owner, guys. But what will the cost of acquisition be? Cost of acquisition will be, listen to the formula, whatever I taxed under IFOS plus whatever money, whatever consideration was paid by me. Did Blue pay any consideration to Red? 0. What was taxed under IFOS? Under IFOS, 80,000 was taxed. 80,000 plus 0, 80,000 will be cost of acquisition. Balance 20,000 will be capital gains. Okay, 49 subsection 4. Under 49 subsection 4, the trick here is, you will remember the previous owner you should not consider. That you will remember. But the trick here is remembering what is cost of acquisition. What is cost of acquisition in 49 subsection 4 cases? Whatever was taxed for me under IFOS plus whatever consideration Blue had paid to Mr. Red. Come on, once again. In 49 subsection 1, what is cost of acquisition? Cost to the previous owner. Period of holding includes previous owner's period of holding. In 49 subsection 4, what is the cost of acquisition? Whatever was taxed for me under IFOS plus whatever consideration I had paid. All right. Now, shall we twist the example? I'll twist it only if you are all thorough with this. Yes, you're ready for a complication? Listen. Let us see. Take it as a challenge, okay? No silly mistakes. This time, what happened is, he did not give it as a gift and all. Red said, enough of giving gifts and all. Red gave jewels to Mr. Blue. Blue said, I'm your friend. Will you charge me entire 80,000 rupees? Red said, okay, fine. Don't give me entire 80,000 rupees. At least give me 10,000 rupees. Blue said okay. So how much did Blue pay for the jewels? Blue paid 10,000 rupees for the jewels. Rest of the story, exactly the same. Okay. What has happened here? Long ago, on 1st April 2021, Red purchased jewels 60,000 rupees. On 1st June 2021, these jewels have an FMV of 80,000 rupees. Then what did Mr. Red do? Red sold these jewels to Mr. Blue, who is his friend, for 10,000 rupees. All right. And then Mr. Blue later sold these jewels to Mr. Green for 1 lakh rupees. Question number 1. In the hands of Red, will there be capital gains calculation? In the hands of Red, will there be capital gains calculation? Yes or no? Come on. Tell me. Everybody participate. In the hands of Red, will there be capital gains? Yes or no? See, you can't be a cat on the wall. You have to take a decision. Yes or no? There will be capital gains. Perfect answers, guys. Very good. There will be capital gains in the hands of Red, because think from capital gains perspective. Capital gains perspective, is it a gift? No. In capital gains perspective, you are getting something in return. Able to connect? Consideration may be adequate, it may be inadequate. It is not necessary that consideration should be full 80,000. Consideration can be even a small number. Right? Inadequate consideration, it's okay. In the hands of Red, there will be capital gains. Okay? In the hands of Red, what will full value consideration be? Full value consideration will be 10,000 rupees. Minus cost of acquisition will be what? How much did Red spend? 60,000 rupees. So for Red, what will be the net number? 50,000 rupees. This will be his loss. This will be his capital loss. Okay, Red over. Think about Mr. Blue now. For Mr. Blue, will there be any IFOS taxation? Yes or no? Yes. For Mr. Blue, yes, there will be IFOS taxation, because Mr. Blue is acquiring movable assets for inadequate consideration. Something worth 80,000 rupees, he's spending only 10,000 rupees. What is the difference? The difference is 70,000 rupees, which is more than how much? Which is more than 50,000 rupees. Movable asset, inadequate consideration. The difference will be taxed on Mr. Blue, more than 50,000 rupees. Okay. Now, later when Mr. Blue transfers this asset, section 49 subsection, which subsection will apply? Subsection 4 will apply. Why? When Mr. Blue received the gift, 70,000 was taxable for him. When I received the gift, something was taxable for me under IFOS. Same thing when I transfer later, what will apply? 49 subsection 4 will apply. Under 49 subsection 4, what will the period of holding be? I will ignore previous owner. My period of holding will start when I acquired the asset, 1st June 2021. It will end when I transferred the asset, 1st August 2021. Full value consideration will be 1 lakh. You think and tell me, what will the cost of acquisition be? What will the cost of acquisition be? Cost of acquisition, what formula did I tell you? Under 49 subsection 4, you will see what was your IFOS taxation plus what was the consideration you paid. What was your IFOS taxation? IFOS taxation was 70,000. How much consideration you paid? 10,000. So total cost of acquisition, 80,000. Net number, 20,000. Now understood. Yes, this must have been a very good learning for many of you, I'm very sure. 49 subsection 1 and 49 subsection 4, you cannot go wrong. According to me, in your upcoming, I spent so much time on this one particular thing, because according to me, your upcoming November examination, you will have a solid adjustment on 49 subsection 4 according to me. MCQ or in descriptive part, one of the two places, 49 subsection 4, highly expected in your November 2022 examination. All right. You know how to make it simpler? Make it simpler like this. When I received the gift, it was exempt for me. Later, when I transfer it, 49 subsection 1, I will consider previous owner. When I received the gift, it was taxable for me. Later, when I transfer, 49 subsection 4. Under 49 subsection 4, what will be the cost of acquisition? Whatever was taxable for me under IFOS plus whatever consideration I paid. This is 49 subsection 4. Okay, so we have learned how many situations now? We have learned 4 situations already. Shall I take you to the 5th situation now, guys? Yes, come on, let us go to the 5th situation, situation number 5. Our first situation was date of acquisition before 1st April 2001. Our second situation was liquidation. Our third situation was 49 subsection 1 cases. Our fourth situation was 49 subsection 4 cases. Now listen to my next discussion, my 5th situation. I'm talking about conversion cases now. Try to be participative, okay? Conversion of stock in trade into capital asset I will discuss first. Then I will discuss capital asset into stock in trade. Okay? Conversion of stock in trade into capital asset. Come on, guys, listen. You tell me. Let us take a situation. I had a person, Mr. Red. This person, Mr. Red, he was a jeweler. Okay. He had some jewels. So he's a jeweler. So for him, these jewels will be what? Stock in trade. Right? He had purchased these jewels long ago. On 1st April 2018, he had purchased these jewels. Later, let us say, on 1st June 2018, he decides to end his jewelry business. He shuts down his jewelry business. And what does he do with this stock in trade? Whatever stock in trade, whatever jewelry he had, he's converting that jewelry now into what? He's converting that jewels into capital asset now. You understood? Yes, on 1st April 2018, he had acquired some jewels, and these jewels were his stock in trade. This stock in trade he's converting into capital asset. On 1st June 2018, he decides to end his jewelry business. So whatever stock in trade he was having, now it becomes his capital asset. Now, later what happens, this capital asset, this jewels, later he transfers, later he sells off these jewels. On 1st September 2018, he sells them off to another person. Now at this stage, capital gains will arise, right? When he transfers this, capital gains will arise by, because what is he transferring? He's transferring in capital asset now. Earlier, it was stock in trade, no doubt, but now the stock in trade got converted into a capital asset. Stock in trade got converted into capital asset, and this capital asset he is now transferring. He's transferring a capital asset, so capital gains will obviously arise. When you calculate these capital gains, what will the period of holding be? Tell me the starting date. Will it be 1st April or will it be 1st June? 1st April or 1st June? Period of holding will start on 1st June 2018. Period of holding will start on the date of conversion. Period of holding will start on the date on which it became a capital asset, 1st June 2018 to 1st September 2018. Right? Now, what will be the cost? Full value consideration will be whatever the selling price is, but what will the cost of acquisition be? Cost of acquisition. Whatever is the FMV. FMV on which date? FMV on the date of conversion. FMV on 1st June 2018. FMV on this date will become his cost of acquisition. Got it? So conversion of stock in trade into capital asset. By the way, conversion of stock in trade into capital asset. Remember yesterday, even PGBP discussion, we spoke about this. Do you recall? Yes, conversion of stock in trade into capital asset. What did we discuss? What to do in PGBP? The same FMV number will be taxed as what? Will be taxed under PGBP, right? So whatever is the FMV on the date of conversion, it will be taxed as PGBP under PGBP, and under capital gains, that same FMV on date of conversion will become cost of acquisition. Are you able to connect provisions? We discussed yesterday only. Okay, so come on guys, one quick revision. Let us conclude now. If I have stock in trade, if I convert the stock in trade into capital asset, and later when I sell away this capital asset, what happens? When I transfer this capital asset, then capital gains will arise. When I compute these capital gains, my period of holding will start when? My period of holding will start on the date of, come on guys, my period of holding will start on the date of conversion. And what will my cost of acquisition be? My cost of acquisition will be the FMV on the date of conversion. This is from the capital gains perspective. Okay, but when I convert stock in trade into capital asset, it will also result into PGBP. Under PGBP, what will be taxed? Whatever is the FMV on the date of conversion. Whatever is the FMV on the date of conversion, that will be taxable for me under the head PGBP. Now, summary. Perfect. Okay, this was my fifth situation. I am converting my stock in trade into capital asset. Now listen to my next situation, my sixth situation. This time I am going to convert capital asset into stock in trade. Capital asset into stock in trade. What we just discussed was stock in trade into capital asset. Now ulta, I have capital asset, I am converting capital asset into stock in trade. I'll again give you an example. Again, Mr. Red. This Mr. Red, he was a paper manufacturer, let us see. Okay, long back, he had purchased some jewels. He had purchased jewels on 1st April 2021. He had purchased them for whatever 60,000 rupees, let us say. Then, so for him, these jewels are capital asset or stock in trade? For Mr. Red, these jewels will be capital asset, right? Because he's a paper manufacturer, so not connected to his business, jewels. So these jewels are his capital asset. Later, what Mr. Red decides is, he decides to start a jewelry business. He starts his jewelry business on 1st October 2018. When he starts his jewelry business, these jewels he converts into what? These jewels he converts into his stock in trade. Okay. Later, this stock in trade he sells to a customer. He sells, let us say, on 1st December 2000, let me change the dates, 1st October 2021, and let us say 1st December 2022, he sold it to a customer. Is the story clear? Point number one, he's a paper manufacturer. He had capital asset. This capital asset he converted into stock in trade on 1st October 2021, and later that stock in trade he sold to the customer. Let us go step by step. First of all, he converted into stock in trade. This conversion itself will amount to what? This conversion of capital asset into stock in trade, this itself will amount to transfer. Okay, when it amounts to transfer, when you compute capital gains, what will the full value consideration be? Full value consideration will be whatever is the FMV. FMV on which date? FMV on the date of conversion will be the full value consideration. Then period of holding. When will period of holding end? Period of holding will end on, you tell me the date. When will the period of holding start? It will start whenever you acquired the jewels, 1st April 2021. When will period of holding end? Will it end on this date or will it end on this date? It will end on the date of conversion. It will end on 1st October 2021. Why? Because on the date of conversion itself amounts to transfer. You will treat as if my assessee has sold away the asset. Right? The conversion itself amounts to transfer. You will treat as if my assessee has sold away the asset. So my period of holding will end on 1st October 2021 on the date of conversion. But then, special point. Generally, previous year of transfer itself is previous year of taxation. But in this case, what will the previous year of transfer be? Previous year of transfer will be the previous year in which you did the conversion. But when will you tax the capital gains? You will tax the capital gains only in the year in which you sold the stock in trade. So whatever capital gains you computed, these capital gains will be taxed when? Which year did we sell? We sold them in previous year 22-23. So it will be taxed in previous year 22-23. Understood? When you sell them, what else will apply? You're selling stock in trade, guys. So when you sell stock in trade, which head will come into your mind? Selling stock in trade, PGBP will come to your mind. Under PGBP, the selling price will be whatever you're selling the jewels for, but what will the cost price be? Cost price will be the same FMV on the date of conversion. Okay, so listen guys, let us revise. What happened here? I had a capital asset. This capital asset we converted into stock in trade, and this stock in trade later on we sold. First of all, conversion of capital asset into stock in trade. This conversion itself amounts to what? This conversion itself amounts to transfer, and hence there will be capital gains. Point number one, when will the period of holding end? Period of holding will end on the date of sale? No. Period of holding will end on the date of conversion. Okay. When you're computing capital gains, what will your full value consideration be? Your full value consideration will be the FMV number. FMV on which date? FMV on the date of FMV on which date? Full value consideration will be the FMV on the date of conversion. The same FMV on the date of conversion will be a full value consideration. Okay, but then these capital gains will be taxed when? They will be taxed only in the previous year in which I sell the stock in trade. Okay, then when I sell my stock in trade, at this stage, what will arise? When I sell my stock in trade, PGBP will arise. When I compute PGBP, what will the cost price be? The same FMV number on the date of conversion, the same FMV number on date of conversion, which is FVC for capital gains, that same number will become cost price for PGBP. Now perfectly understood? Yes, these two summaries will give you very good clarity. When you convert stock in trade into capital asset, this conversion will result into PGBP. The FMV on the date of conversion will be taxable. This capital asset later, when you transfer this capital asset, then capital gains will arise, right? Under capital gains, your period of holding will start on the date of conversion, and your cost of acquisition will be whatever is the FMV on the date of conversion, that will be your cost of acquisition. Then we learned if you're converting capital asset into stock in trade, this conversion itself will amount to transfer, but it will be taxed only in the year in which we sell the stock in trade. Guys, this exception, where else did we discuss about already? This exception we already discussed in which case? We already discussed a similar exception in liquidation. Now we are discussing in conversion of capital asset into stock in trade. It will be taxed only in the year in which we sell the stock in trade. Are we perfectly clear about this also? Can I take you to the next situation, guys? Yes, so this was my situation number 6. All right, let us go to the 7th situation now. Our first situation was acquiring the asset before 1st April 2001. Then we spoke about liquidation. Then we spoke about 49.1, 49.4. Then after 49.1, 49.4, we spoke about conversion of stock in trade into capital asset, and then conversion of capital asset into stock in trade. Now listen to our next discussion, amalgamation. Two simple discussions let us have now. We've been doing a lot of heavy learning, so two simple discussions now. Listen to me. We have a company, A Limited. This A Limited is going to merge with B Limited. Okay, this person, Mr. Red, he is a shareholder of A Limited. Now, you tell me, when A Limited merges with B Limited, will A Limited continue to exist? No, right? A Limited will automatically come to an end. So, will Red continue to be shareholder of A Limited? No, these shares will come to an end, and in return, what will he get? In return, he will get shares of B Limited. So don't you think it is actually nothing but an exchange? Don't you think it is as if I am giving up shares of A Limited and in return I'm getting shares of B Limited? Yes, it is like an exchange, but this exchange will not be considered as transfer, and at this stage, there will be no capital gains. But later, this Mr. Red, when he sells away the shares of B Limited, now at this stage, there will be capital gains, right? Yes, at this stage, there will be capital gains. What will his period of holding be? Period of holding will also include the period which he held the shares of A Limited. What will his cost of acquisition be? His cost of acquisition will be cost of acquiring A Limited's shares. All right, listen. Let us say Mr. Red was a shareholder of A Limited, right? He had acquired the shares of A Limited on 1st of April 2021. Merger happened on 1st of June 2021. He got the shares of B Limited on 1st June 2021, and he sold away the shares of B Limited, let us say, on 1st August 2021. He had acquired the shares of A Limited, let us say, for 60,000 rupees, and on the date of merger, the FMV of these shares was, let us say, 80,000 rupees. Now tell me, period of holding will be what? What is a capital asset? What is a capital asset? What is Red selling? Capital asset is shares of B Limited, right? Red is selling the shares of B Limited. So when will the period of holding start? Tell me the date. Will this be the period of holding starting date, or will this be the starting date? 1st April 2021. Right? Period of holding will start from when I acquired the shares of A Limited, and it will end on the date of transfer, which is 1st August 2021. What will the cost of acquisition be? The cost of acquisition will be cost of acquiring the shares of A Limited, which is 60,000 rupees. All right, so simple. 2 points over here, 2 points you have to remember. Mr. Red, the shareholder of A Limited, his shares in A Limited will come to an end and he will get shares of B Limited. No doubt it is like an exchange. It is as if Mr. Red has given up shares of A Limited and in return he is getting shares of B Limited. No doubt it is a case of exchange. But this exchange will not be considered as transfer and there will not be any capital gains at all. Okay, then point number 2 we learned, when Mr. Red later sells away the shares of B Limited, now capital gains will arise. So his period of holding will include even A Limited's period of holding. His cost of acquisition will be the cost of acquiring A Limited shares. Now perfectly understood. Okay, this was amalgamation. Now let us talk about under the same situation itself, let us finish off demerger also. Okay, here let us say we had a company A Limited. This A Limited was doing paper business and it was doing steel business. It was becoming difficult for the company to handle all the assets. So the paper assets were, let us say 60% of the assets were paper assets and 40% of the assets were steel assets. So what the company did is it continued to keep the paper assets, but the steel assets and all, it demerged, it made another company B Limited and all the steel assets it gave to B Limited. So B Limited is going to be doing the steel business. Now, this person, Mr. Red, he was a shareholder of A Limited. Okay, long before demerger and all happened, long before that itself, Mr. Red had purchased shares of A Limited. Date of acquisition was 1st April 2021 and the cost of acquisition, he had acquired the shares of A Limited for, let us say, 120 rupees per share he had acquired. Okay, demerger happened on 1st of June 2021. Now, when demerger happens, automatically Red will also get shares of what? Red will also get shares of B Limited. Red is already having shares of A Limited. Now, A Limited is demerging into B Limited. All of A Limited's shareholders will also become shareholders of B Limited now. So, Red will have 2 shares now. Red will have 2 assets now. Red will have shares of A Limited and Red will also have shares of B Limited. Do you agree till here? Yes, he was having shares of A Limited, okay? A Limited demerged into B Limited. It kept the paper business, steel business, it gave off to B Limited. All right. Now, A Limited shares also Red is having and Red upon demerger will also get B Limited shares. So, Red is having 2 assets in his hands, A Limited shares and B Limited shares. Mr. Red wants to sell off all the shares. All right. Answer my question. First of all, what will the period of holding be? What will the period of holding be? For A Limited shares and for B Limited shares, for both period of holding will be the same, which will start when? 1st April 2021, perfect. That is not a doubt. The doubt is cost of acquisition. What will the cost of acquisition be? Tell me, A Limited, what will the cost of acquisition be? For A Limited, the cost of acquisition will be 120 into 60%. For B Limited, what will the cost of acquisition be? 120 into 40%. Right? See, the cost of acquisition of A Limited will be whatever was the cost of acquiring shares in A Limited. What was the cost of acquiring shares in A Limited? 120 rupees. 120 rupees into book value of assets retained divided by net worth before merger. There's a formula. What's the formula? The formula is the original cost of acquisition into book value of assets which are retained divided by net worth before merger. So cost of acquisition is how much originally? 120 rupees. What is the book value of assets retained? I have not given the book value, instead I'm using percentages. So 60% to 60 divided by 100. Total 60 plus 40, total 100 rupees assets. Total 100 was the net worth of A Limited, let us see. A Limited is going to keep only 60% of its net worth. 40% of its net worth is going to give to B Limited. So in the same ratio, even the cost of acquisition will be split. Cost of acquisition of A Limited shares will be 60% and cost of acquisition of B Limited shares will be 40%. So what will be the cost of acquisition of A Limited shares now? 72 rupees. Cost of acquisition of B Limited shares will be the balance 48 rupees. In the same ratio, guys, in the same ratio, the cost of acquisition will get split between both the companies. Remember this formula. This is going to be the cost of acquisition of A Limited shares. Okay, what is A Limited? What will you call A Limited? The demerged company. And what will you call B Limited? B Limited will be the resulting company, right? So demerged company's cost of acquisition will be whatever was the original cost of acquisition into book value of assets retained divided by total net worth before demerger. So 120 rupees into 60 by 100, that's going to be the cost of acquisition for A Limited. The balance cost of acquisition, 120 minus 72, balance 48 will be the cost of acquisition of B Limited shares. This is demerger. Hello, is anybody there? Are we awake? Are we following? Yes. So this was our discussion regarding amalgamation and demerger. All right. So guys, did we follow this part? Yes. So and also remember the capital asset conversion cases. Conversion of stock in trade into capital asset. What do you do here? Conversion of stock in trade into capital asset will amount to PGBP. FMV on date of conversion will be taxable under PGBP. When you transfer later, capital gains will arise. Period of holding will start from the date of conversion. Cost of acquisition will be FMV on the date of conversion. Capital asset, if you convert into stock in trade, this conversion will amount to capital gains. It will amount to transfer. Period of holding will end on the date of conversion, but taxation will happen only in the year in which you sell the stock in trade. The same FMV on date of conversion will be FPC for capital gains calculation, and the same FMV will be cost price under PGBP. And then we learned about amalgamation and demerger. Okay, at this stage, let us take a small pause, an exact 5 minutes pause maybe. Okay, an exact 5 minutes pause, and then we will resume. Once you're back, I'll resume the discussion regarding the rest of the situations. Shall we resume, guys? Are you all back? Let's resume. Let's go ahead to the rest of the discussion. All right. So until now, we have learned how many situations? We have learned 7 situations. The last situation we learned was amalgamation and demerger. Even in amalgamation, period of holding will include even the period for which I held A Limited shares. Even in demerger, the period of holding for both will include from the date on which I purchased A Limited shares. Monica, all right? Okay. For A Limited shares and for B Limited shares, for both, period of holding will start on 1st April 2021. Okay, now let me take you to the next discussion, guys. Our next situation, here I'm going to be talking about conversion of debentures into equity shares. The same concept which I'm going to be discussing with you about debentures into equity shares, the same concept will also apply when I convert preference shares into equity shares. Okay, so conversion of debentures into equity shares and conversion of preference shares into equity shares, same concept. Let us say there is a company A Limited. Okay, and in this company, this person, Mr. Blue, he is a debenture holder in this company. Okay, he purchased the debentures on 1st April 2021. He purchased them for 1,000 rupees, let us say. Later, what happened is these debentures, they got converted into equity shares. They got converted into equity shares on 1st December 2021. And later, these equity shares, he transferred on, let us say, 1st of January 2022. Okay, now the question is, when he's transferring the equity shares, at this stage, capital gains will arise, guys. Yes, so what will his period of holding be? When will his period of holding start? What is he transferring? He's transferring equity shares, but these are debentures which were converted into equity shares, and that is why the period of holding will include even the period for which you held the debentures. Period of holding will start on 1st April 2021 and it will end on 1st January 2022. What will the cost of acquisition be? Cost of acquisition will be the cost for which you had acquired the debentures, which is 1,000 rupees. Same thing applies even for preference shares. If you had preference shares and these preference shares you converted into equity shares. By the way, will this conversion amount to transfer? Will this conversion result into capital gains? No, this conversion is not a transfer. This conversion will not result into capital gains at all. Okay, then will capital gains arise? Only when I sell away these equity shares, only then capital gains will arise. When you sell away these equity shares, your period of holding will include the period for which you had held the debentures, and your cost of acquisition will be the cost for which you had acquired the debentures. Simple. All right. Now listen to my next discussion. My next special situation is about rights issue. In case we make a rights issue, in such cases, how will you calculate the capital gains? Here, you need to understand very carefully. Let us take a situation. We have a company A Limited and there is a person, Mr. Red. This person is a shareholder of A Limited. He is already having 10 shares of A Limited. These 10 shares he had acquired on 1st April 2021, let us say. Now, this company announces a rights issue. Rights issue means who is going to subscribe to the shares? Only the existing shareholders, right? The company says you will get 2 rights shares for every 1 share. Or wait, the company says rights share issue 1:2. 1:2 means what? You will get 1 rights shares for every 2 shares that you hold. You agree with this? 1:2 would mean you will get 1 rights share for every 2 shares that you hold. And rights shares, will it be for free? Of course not. You have to pay for the rights. Per right, you have to pay 10 rupees, let us say. All right. So Mr. Red has the right to acquire how many rights shares? He has the right to acquire how many rights shares? He has the right to acquire 5 rights shares. Do you all agree with me? He has 10 shares. See, for every 2 shares that you hold, you have the right to get 1 share. Mr. Red already owns 10 shares, so he has the right to get how many shares? 10 divided by 2, he has the right to get 5 shares. Okay, now is it mandatory that he has to acquire all the 5 shares? No, he has a choice. He has 3 choices. Choice number 1, he can subscribe to the right, which means he can accept the right and he can buy the rights. Let us say out of 5 shares, 2 shares he subscribed, he decided to buy. Then second option is he can reject the right. He can say, I don't want the shares. For 1 share, he said, I don't want. And the third option he has is he can renounce. He can renounce in favor of any person. The person to whom he is renouncing, that person, should he necessarily be an existing shareholder of the company? No. The person to whom he is renouncing may be a shareholder, may not be a shareholder. Let us say 2 shares he renounced in favor of somebody else. Okay, these 2 shares he subscribed. These 2 shares that he subscribed, for these 2 shares, what will the period of holding be? Period of holding will start on the date of allotment. We will see when, where these 2 shares allotted to him, that is when the period of holding will start. What will the cost of acquisition of these 2 shares be? How much is he going to pay for the rights issue? 10 rupees per share, that will be his cost of acquisition. See guys, you will treat these 2 shares as 2 totally different shares. Do not club this calculation with the 10 shares calculation. 10 shares you will do separate calculation. These 2 shares you will do separate calculation. For these 2 shares, no complication. Period of holding will start whenever he got these 2 shares, whenever these 2 shares were allotted to him. Cost of acquisition will be whatever he's paid for these 2 shares. This is simple. Subscription part, these 2 shares simple. The 1 share which he rejected, for this any capital gains implication, any tax implication for this 1 share? No, for this 1 share, no tax implication at all. What about these 2 shares? These 2 shares, let us say he renounced these 2 shares to this person, Mr. Green. Mr. Green, in return for the renunciation, gave him 2 rupees per share. So how much money did Mr. Red get against these 2 shares which he renounced? He got 4 rupees per share. This is going to be his full value consideration. Are you following? He renounced 2 shares. He gave up 2 shares. He gave up 2 shares to Mr. Green. In return, he got 2 rupees per share. So full value consideration is 4. But what is his cost of acquisition? Did he pay anything to get this right? His cost of acquisition will be 0. Balance 4 will be his short-term capital gain. Let us go a little bit deeper here. Tell me, for these 2 shares, what is a capital asset being transferred? What is the capital asset being transferred over here? Is it rights share? It is not rights share. It is right to acquire rights shares. It is right to subscribe to rights shares. See, Mr. Red is not selling rights shares to Green. He is selling to Green only the right to acquire rights shares. Are you understanding the difference? Mr. Red is not transferring to Mr. Green the rights shares. Mr. Red is not transferring shares to Mr. Green. Mr. Red is giving Mr. Green only and only the right to buy the rights shares. To get this right, he paid nothing. So cost of acquisition is 0 and will always be short-term capital gain because the period will never be more than 36 months. What period? What will be the relevant period of holding here? 12, 24, 36. For this right to acquire rights shares, it's going to be 36 months. The relevant period of holding will be 36 months and it will never be more than 36 months. It will always be short-term capital gain. Now, can we think from Green's perspective? For Green, what will his cost of acquisition be? Tell me. Per share. What is his cost of acquisition per share? He will have to pay 10 rupees to the company plus he had to pay 2 rupees to Mr. Red. So for him, cost of acquisition will be 12 rupees per share. This is my entire discussion regarding rights issue. See, rights issue, the complication is not here. For whatever shares you're subscribing, that part is simple. Cost of acquisition will be whatever you're paying to the company. Period of holding will start on whenever the shares were allotted to you. Here, no complication. Whatever rights you're rejecting, even there, no tax implication, even though no complication. Complication is only for the renunciation part. Whatever you're getting for the right which you renounced, that's going to be taxed as your STCG. There will be no cost of acquisition. Cost of acquisition will be nil. The person to whom you're renouncing, for this person, the cost of acquisition will be whatever he's going to pay to the company, 10 rupees per share, and whatever he's going to pay to Mr. Red for the renounced right, 2 rupees per share. So 12 rupees per share is going to be the cost of acquisition for Mr. Green. This is it about my discussion regarding rights shares. Did you understand? Yes, always remember guys, always remember whenever you have shares in the question, even though all the shares belong to the same company, if you have different dates of acquisition, if you have different kinds of shares, you need separate columns. Like for example, here, when you do the calculation for Mr. Red, you will do separate calculation for original shares and you will do separate calculation for rights shares. Even though both the shares belong to the same company, do not club them into one single column, have separate columns. Why? Because you have different periods of holding, you have different cost of acquisition. So there will be different rules and regulations applicable, different provisions applicable, right? So even though both are shares of A Limited, do not do a combined calculation for 12 shares. For these 10 shares, separate calculation. For these 2 shares, separate calculation. Okay, now listen to my next situation, my next adjustment, bonus shares. For bonus shares, do we pay anything to acquire them? No. Bonus shares are always given to us for free. Bonus shares are always given to the assessee for free, right? Now, in case my assessee is later transferring these bonus shares, when he transfers the bonus shares, capital gains will arise, guys. The whole question is, what will the cost of acquisition be? The cost of acquisition will depend upon the date of acquisition. Was the date of acquisition before 1st April 2001 or was the date of acquisition on or after 1st April 2001? On or after 1st April 2001, very simple. What will the cost of acquisition be, guys? Come on, quickly tell me. On or after 1st April 2001, it's going to be 0. But before date of acquisition, before 1st April 2001, what will the cost of acquisition be? See, whenever we acquire an asset before 1st April 2001, what do we always compare? We compare the actual cost of acquisition with FMV. FMV on which date? FMV on 1st April 2001. Will I talk about SDV and all? No, it is not a movable property. So what is the actual cost of acquisition? Bonus shares. Actual cost of acquisition will be 0. So we will compare 0 with FMV number. Out of these two numbers, we will pick whichever is higher. Obviously, guys, which will be higher? The FMV number. Right? So in case I'm talking about bonus shares, then what will the cost of acquisition be? Cost of acquisition will be, did I acquire the shares before 1st April 2001 or were the bonus shares allotted to me on or after 1st April 2001? On or after 1st April 2001, cost of acquisition will be 0. But if the shares were allotted to me before 1st April 2001, then what will the cost of acquisition be? FMV on 1st April 2001. Actual or FMV, whichever is higher you will pick, and obviously which will be higher? Obviously, the FMV number will be higher because the actual cost will anyways be 0. Is this clear? This was a simple discussion. This was regarding bonus shares. Okay, now listen to my next situation. My 11th situation, we're talking about sweat equity shares. Sweat equity shares, or I can also apply the same concept to ESOPs. All right. For the sweat equity shares, point number 1, when will the period of holding start? Period of holding, when will it start? It will start on the date of allotment, right? And when will it end? It will end whenever I transfer the shares. This is fine. The only complication here is cost of acquisition. What will the cost of acquisition be? See, for sweat equity shares, for ESOPs and all, I would have paid the exercise price. Will you consider the exercise price under the cost of acquisition? No, not the exercise price. Instead, what will you consider? You will consider the FMV. FMV on which date? FMV on the date of exercise of option. That will be considered as your cost of acquisition number. Okay, so sweat equity shares and ESOPs, you will not take the exercise price as cost of acquisition. You will take the FMV on the date of exercise of option. FMV on the date of exercise of option, this is going to become your cost of acquisition. Okay, FMV on the date of exercise of option. All right, this I'm talking about whenever you transfer the shares later. When you transfer the shares later, there will be capital gains. To compute capital gains, your cost of acquisition will be FMV on the rate of exercise of option. Let us deviate for 2-3 minutes. Let us talk about allotment. When you had exercised the shares, when you had exercised the option, when the shares were allotted to you, at that time, which head will be applicable to you? When you had exercised the option, when the shares were allotted to you, at that time, salaries head would be attracted, guys. Under salaries head, tell me, what will be the previous year of taxation? When will you tax the income? Will you tax it in the year in which you exercised the option, or will you tax it in the year in which the shares were allotted to you? You will tax it in the previous year of allotment. You will see when were the shares allotted to you, in that year you will tax it. Perfect answer. Answer my next question. How will you compute the taxable value of the perquisite? You will see the FMV. FMV on which date? Anybody? You will take FMV on the date of exercise of option, right? And from this, what will we subtract? We will subtract the exercise price. We will subtract whatever amount employee has paid for the shares. The net number that you get, this is going to be the taxable value. All right, so I just gave you a 360-degree view of the entire concept. When the sweat equity shares were allotted to you, when you had exercised the option, at that time you will have taxation under the head salary. Under the head salary, you will tax the perquisite only in the year in which the shares are being allotted to you, right? But how do you calculate? You will take the FMV on the date of exercise of option, and from that you will subtract whatever exercise price you have paid. The balance number will be your taxable value. But these shares, these same shares, later when you sell, there will be capital gains. When you're computing capital gains, what will the cost of acquisition be? The same FMV on the date of exercise of option, that same FMV will become your cost of acquisition when you sell away those shares. Is this clear? Yes, the same FMV number, which is on the date of exercise of option, that same FMV number you will use in two places. In computation of taxable value of perquisite, also you will consider that number, and that same number will become your cost of acquisition later when you sell away the shares. When you sell away the shares, the amount which you paid, exercise price, you will not consider. When you sell away the shares, FMV on date of exercise of option will become your cost of acquisition. Perfect understanding? Were you able to absorb this? Any confusion, any complication? No? Perfect. Now listen to the next discussion, guys. My next situation. In my next situation, I'm talking about insurance compensation cases. Listen. Here what happens. My assessee, Mr. Blue, he had a house. This house got destroyed. It got destroyed because of fire. He thankfully had a fire insurance policy. So the insurance company gave him some insurance compensation. This whole episode will result into transfer, guys. Do you agree? And there will be capital gains. Do you agree? Right? But to compute capital gains, what are the conditions? Condition number 1, why did the destruction happen? Will you cover every destruction? No. Destruction should be only because of 4 things. Destruction should be only because of 4 things. Number 1, either the destruction should be because of a natural calamity. For example, because of an earthquake, because of a tsunami, because of a natural calamity. Or the destruction should be because of fire. Or the destruction should be because of a war. Or the destruction should be because of some riot or because of some civil disturbance. All right. So the destruction should be because of these purposes. For example, theft. Is theft covered here? Theft is not covered here. The destruction should be only because of these 4 things. What are the 4 things? Come on, guys, everybody. Natural calamity, fire, war, riot, or civil disturbance. Again, natural calamity, fire, war, riot, or any civil disturbance. Natural calamity, fire, war, riot, or any civil disturbance. The destruction should be only because of these 4 things. Then, when the insurance company gives us compensation, yes, it will result into capital gains. But tell me, when will the period of holding end? Will the period of holding end on the date on which on the date of destruction, or will the period of holding end on the date on which we received the compensation? When will the date of transfer be? The period of holding will end. The date of transfer will be the date of destruction. We will see when did the property get destroyed. That is when the date of transfer will be. That is when the period of holding will end. Okay, then listen. Generally, again, same thing, guys. Generally, when do we tax the capital gains? In the previous year of transfer itself, we tax the capital gains, right? But in insurance compensation cases, when will the previous year of transfer be? The transfer will be in the year of destruction. But when will we tax the capital gains? We will tax the capital gains in the year of receipt of compensation. Perfect understanding? This is insurance compensation cases. In insurance compensation cases, this destruction itself will amount to transfer, but it will amount to transfer only and only if the destruction is because of what 4 things? Tell me without saying. Natural calamity, then fire, then war, Then any riot or any civil disturbance. Natural calamity, fire, war, riot or any civil disturbance. The destruction should be because of any of these four things. Then when will the date of transfer be? On the date of destruction, it will be the date of transfer. So period of holding will end on the date of destruction. Transfer will happen on the date of destruction, but we will not tax the capital gains immediately. We will tax the capital gains only in the year of receipt of compensation. Something very similar to this, where else have we seen? Something very similar to this we've already seen in two places. Number one, we have seen this in liquidation cases. And number two, we have seen in cases where capital asset was converted into stock in trade. Perfect understanding? Yes, this was our discussion regarding insurance compensation. Okay, now listen to my next situation. My next situation is about compulsory acquisition cases. See, what I'm doing here is, for you, I'm taking each point, each concept, and that concept, cost of acquisition, period of holding, date of transfer, taxation, everything we're discussing together. Otherwise, what happens when we learn cost of acquisition alone for everything separately, then period of holding alone if we learn for everything separately, it becomes very confusing, right? So that is why each concept I'm taking, that concepts, cost of acquisition, period of holding, taxation, everything we're discussing together itself. This way, your understanding will be 360-degree view. So whenever you get a question, let us say you get a question about insurance compensation, all these concepts will come to your mind. You will just try to imagine this diagram in your mind. All right, now listen to my next discussion, guys. Compulsory acquisition. Tell me, is compulsory acquisition also going to result into transfer? It's compulsory. Will this also become transfer? Yes. Let us do some memory testing. Transfer, which section? Which section talks about transfer? Section 2 clause 47. Okay, now listen. In case my property gets compulsorily acquired, number one, yes, it will result into transfer. Okay, again the same thing, guys. Generally, when do we do the taxation? Generally, we tax the capital gains in the year of transfer. But in compulsory acquisition cases, what will the previous year of transfer be? The previous year will be the year of compulsory acquisition. But when will we tax the capital gains? We will tax the capital gains only in the year of receipt of compensation. Tell me, do I have to wait to receive the entire compensation to tax it? No, even when I receive a small part of the compensation, in whichever year I receive the small part of compensation, whenever I receive the first part of the compensation, in that year itself, the entire capital gains will be taxed. You're understanding, guys? In whichever year I receive even a small part of the compensation, the first time when I receive the compensation, in that year itself, the entire capital gains will be taxed. But it will be taxed only in the year of receipt, not in the year of transfer. The same rule, where else have we seen? We have seen the same rule in liquidation. Where else, guys? We have seen the same thing in conversion of capital asset into stock in trade. And just now we learned one more case, which was insurance compensation cases. You will not forget this, right? Okay, now listen. Compulsory acquisition cases, I am not okay with the initial compensation. I went to the court. I requested the court, I want more compensation. Court passed an order. Court said, I will get enhanced compensation. I will get additional compensation. Now, this enhanced compensation, additional compensation, when will it be taxed? It will be taxed again in the year of receipt of enhanced compensation. It will be taxed. When you're doing this taxation, tell me, what will the cost of acquisition be? Cost of acquisition will always be zero. Why will it be zero? Because cost of acquisition I have already considered in the initial compensation discussion. See, first I received initial compensation. Let us say government told me they'll give me 20 lakh rupees. So for this 20 lakh initial compensation, I would have subtracted the cost of acquisition and all. I would have calculated capital gains. This number would have been taxed already. Let us say this was long-term capital gains. Okay, but I was not okay with 20 lakhs. I told the court, I want more money. The court took its own sweet time to decide my case. And let us say after 4 to 5 years, court passed an order asking the government to give me 5 lakh more compensation. So in whichever year I receive the compensation, or in whichever year the court passes the order, When will this 5 lakh be taxed? This 5 lakhs will not be taxed in the year in which the court passes the order. It will be taxed in the year in which I receive the compensation. So in the year of receipt of compensation, I will tax this 5 lakhs. But for this calculation, cost of acquisition will be 0 because actual cost of acquisition I have already considered in the initial compensation calculations. So cost of acquisition will be 0, and whatever capital gain I have, will it be long term or will it be short term? Long term or short term will depend upon the original capital gains. If original capital gains are long term, even these capital gains will be long term. If my original capital gains was short term, then even this capital gains will be short term. Did we understand this discussion, everybody? Yes, so compulsory acquisition cases also be taxed only in the year in which we receive the compensation. All right, it will be taxed not in the year of transfer. What will the year of transfer be? Whenever it gets compulsorily acquired, in that year transfer will happen, but it will be taxed only in the year in which we receive the compensation. All right, enhanced compensation also will be taxed only in the year in which I receive the compensation. Okay, enhanced compensation, the cost of acquisition will always be 0. Why will it be 0? It will be 0 because the actual cost of acquisition I've already considered. I've already considered the actual cost of acquisition long ago. When the initial compensation calculation happened, I've already considered. For enhanced compensation, it will be long term or short term. It will depend upon the original capital gains. Shall I close this story? But wait. There's one more point in compulsory acquisition. This entire compulsory acquisition concept does not apply to urban agricultural land. Why? Because section 1037 applies. When does 1037 apply? Assessee happens to be individual or HUF. What is a capital asset? Urban agricultural land. Is urban agricultural land a capital asset, by the way? Yes. Only rural agricultural land is not a capital asset. Urban agricultural land is a capital asset. My capital asset is urban agricultural land, okay? And this urban agricultural land, what is the mode of transfer? This is being compulsorily acquired. Okay. By the way, what do you mean by urban agricultural land? What do you mean by an agricultural land? An agricultural land is a land which is being used for agricultural purposes for how many years? For at least the last 2 years, it must have been used for agricultural purposes. See, 2 years, who is using it for agricultural purposes doesn't matter. Assessee, any other person who was using it for agricultural purposes doesn't matter. What matters that the land was being used for agricultural purposes. Whoever was using the land, they were using the land for agricultural purposes when last 2 years at least they were using it for agricultural purposes. So I have an urban agricultural land. This urban agricultural land is being compulsorily acquired. If all the 3 conditions are fulfilled, then whatever capital gains I have, guys, short term, long term, whatever capital gains I have, these capital gains will be fully exempt. Understood? Yes, so this is section 1037. 1037 assesses an individual or HUF. The capital asset is an urban agricultural land. It is being transferred by way of compulsory acquisition. If all these conditions are fulfilled, my capital gains, whether short term or long term, will be taxed in the will be fully exempt, but applicable only to urban agricultural land. Why am I not covering rural agricultural land? I'm not covering rural agricultural land because rural agricultural land is not even a capital asset in the first place. So in simple words, guys, what I can do is I can simply make a flowchart. See, my agricultural land may be a rural agricultural land. It may be urban agricultural land. This rural agricultural land is not even a capital asset. Therefore, no capital gains at all. But when I talk about urban agricultural land, yes, it is a capital asset. If this urban agricultural land is getting transferred, I will see how is it getting transferred. Is it getting transferred by way of compulsory acquisition or is it getting transferred by any other mode? If it is getting transferred by compulsory acquisition, then section 1037 exemption you will apply. If it is getting transferred by any other mode, then it's going to be taxable. Now perfect. Okay, urban agricultural land, it is a capital asset. In case it is being transferred, you will see, is it being transferred because of compulsory acquisition or any other mode? If it is being transferred by compulsory acquisition, then 1037 exemption. If it is being transferred by any other mode, then it will be taxable. Okay, so this is it about our compulsory acquisition cases. For enhanced compensation, you can subtract expenses on transfer. To get the enhanced compensation, whatever expenses you've incurred, whatever legal expenses you've incurred to get the enhanced compensation, that you can subtract as expenses on transfer. All right, listen to my next situation now, my next concept. My next concept is about section 50C. Section 50C you should be able to grasp very quickly because it's very, very similar to section 43C, which we've learned earlier. 50C, we have some conditions. Condition number 1, who should the assessee be? The assessee should not be a real estate dealer. Why? Because if the assessee is a real estate dealer, then not 50C. Which section will apply to him instead? Section 43CA will apply to him instead. Condition number 2, what is a capital asset? The capital asset should be land or building or both. Condition number 3, he sold the asset in such a way that the SDV is more than how much? SDV is more than 110% of full value consideration. This 110%, will it ever become 120%? No, guys, I told you yesterday that 120% concept you keep only in 43CA and you keep in IFOS. You don't keep that you don't bring that concept to 50C. It will always be 110% comparison only. If all these conditions are fulfilled, what will you do? If all these conditions are fulfilled, you will ignore the full value consideration number. You will take the SDV number. This SDV number will be deemed to be full value consideration number. But my assessee, smart assessee, what does he start doing? He starts comparing the SDV with FMV. Then the AO will have to go to valuation officer. Valuation officer will compute what? The valuation officer will compute the FMV of the asset. This FMV, two things are possible. This FMV may be more than SDV or this FMV may be less than SDV. If it is more than SDV, what will you do? You will take the FMV number or the FVC number, whichever is higher. If the FMV is less than SDV number, I will stick to SDV number. Same concept we had learned even in 43CA. Then again tell me SDV, which SDV will you prefer always? You will always prefer SDV on date of agreement. But you can take SDV on date of agreement only if some consideration the buyer has paid to the seller when? On or before date of agreement. How? In specified mode. You can take SDV on date of agreement only if at least some consideration buyer has paid to the seller on or before the date of agreement in specified mode. This is section 50C. 50C, very simple. Yesterday we covered 43CA, same thing. Just here assessee should not be real estate dealer, and here I will never look at 120%. It will always be 110%. Okay, listen guys. Whenever you see immovable property in the question, okay, seller, buyer, immovable property. For seller, what are the tax implications that should come to your mind? Either capital gains, section 50C will apply, or PGBP, section 43CA will apply. For buyer, what concept will apply? For buyer, IFOS will apply. For buyer, you will also think about 194IA TDS. If the compensation which the buyer is giving to the seller is more than 50 lakh or at least 50 lakh, when does 194IA apply? Tell me. TDS, 194IA. If it is at least 50 lakh. If it is at least 50 lakh, then 194IA will apply. Buyer will have to deduct tax at what rate? At 1%. You remember this. If it is immovable property from the seller's perspective, if the seller is not a real estate dealer, then you will apply capital gains 50C. If the seller is a real estate dealer, then you will apply PGBP 43CA. For buyer, you will apply IFOS 56-10. And buyer will also deduct tax under 194IA. Will you remember this? Okay, this was our discussion regarding section 50C. Okay, guys, now let us go to the next discussion. Section 50CA. Section 50CA important. This is one section which students always give a stepmotherly treatment to this section. They just forget about this section in the middle of all the complication, in the midst of all the complications in capital gains. This section takes a backseat. But please remember this carefully, because now slowly the examiner's focus is shifting to this section. When does 50CA apply? What are the conditions? Number one, who should the assessee be? The assessee should not be a stock dealer. He should not be a share trader, which means what is a capital asset over here? The capital asset should be unlisted shares. The capital asset should be unlisted shares. And how is he selling? He's selling in such a way that the FMV of the shares is more than the full value consideration. Here you do not look at 10%, 110%, 120%, no, nothing. Straight away compare FMV and FVC. If all these conditions are fulfilled, then what will you do, guys? The actual full value consideration, dustbin. You will straight away take what? You will straight away take the FMV number. This FMV number will be deemed to be full value consideration. Please notice unlisted shares, not unlisted securities. Unlisted shares, same like, where else do we talk about unlisted shares? Tell me. Where else do we talk about unlisted shares? 24 months. That non-resident foreign currency, there what do we say? There we say unlisted securities. Remember? Where did it go? Here. Here we say unlisted securities. Unlisted shares, where do we use unlisted shares terminology? Unlisted shares terminology we use in two places, 50CA and 24 months. Crystal clear, guys? This is 50CA. 50CA, you sold shares, you sold unlisted shares of a company. You sold them in such a way that the full value FMV was more than full value consideration. You ignore full value consideration number, you take the FMV number deemed to be FVC. Okay, shall I take you to the next discussion now? We'll go to the next concept. Listen, our next concept is going to be important. Listen carefully. We are going to be discussing about intangible assets. Intangible assets. Guys, just give me one. Listen to me. So I'm going to be discussing with you about our next situation, which is intangible assets. Now, what are the concepts you already know about intangible assets? You already know that for intangible assets, do you have any cost of improvement? No cost of improvement for goodwill of business, goodwill of profession. Remember that discussion? In the beginning itself, we had discussed that part. For goodwill of business, goodwill of profession, no cost of improvement. Then, listen to the next point. In case the date of acquisition is before 1st April 2001, generally what do we consider? If the cost of acquisition is before 1st April 2001, then generally we look at FMV on 1st April 2001. I guess it got disrupted again. I hope I've reconnected. Listen. So for date of acquisition, we said that generally the date of acquisition is before 1st April 2001. We consider the FMV number. But for intangible assets, we don't have an option of taking the FMV number. For intangible assets, we will always stick to what? We will always stick to actual cost of acquisition only. So I'll go back to my initial note. Here, if the capital asset is any other capital asset, here what will we change it? We will say in case any other capital asset is intangible capital asset, then you will stick to what? You will stick to actual cost of acquisition only. If it is intangible asset, you don't have the option of taking FMV at all. You will stick to actual cost of acquisition only. Okay. So intangible assets, guys, this is going to be an important discussion. There have been amendments here. So please listen to my discussion carefully. I'll also go a little bit slowly in this part of the discussion. So for intangible assets, point number one, the cost of improvement will always be 0. Point number 2, even if this asset was acquired before 1st April 2001, even then I will not look at the FMV number. I will stick only to the actual cost of acquisition number. Now listen. In case the intangible asset happens to be a specified intangible asset. What do you mean by specified intangible assets? Goodwill of business or profession, trademark of business or profession, tenancy rights, route permits, then loom hours, right to manufacture, right to carry on business or profession. For these specified intangible assets, if they are self-generated intangible assets, then what will the cost of acquisition be? Cost of acquisition will be 0. But if these if you have any other self-generated intangible asset, then in that case, you will not even have any capital gains. All right. See, in case you sold away any intangible asset, what's the first thing you will check? If you sell away any intangible asset, you will check, was it acquired intangible asset or was it self-generated intangible asset? If it was acquired, is it stuck for everybody? Is it stuck for everybody? No, right? Fine. Let me continue then. See, in case we transfer an intangible asset, what will you check? Whenever any intangible asset is transferred, you will check, was it an acquired intangible asset or was it a self-generated intangible asset? If it was an acquired intangible asset, you will see, was it depreciated? See, today, no doubt, we cannot depreciate which intangible asset? We cannot depreciate goodwill. Goodwill of business or profession, we can't depreciate. But other intangible assets, we can depreciate, guys. Right? So in case it was an acquired intangible asset, you see whether it is goodwill of business or goodwill of profession, or was it any other intangible asset? If it is goodwill of business or profession, then you see, was it depreciated? See, today we cannot depreciate, but then up to 1st April 2020, we were allowed to depreciate. So was it depreciated up to 1st April 2020? If yes, a different treatment, we'll see that later. If it was not depreciated at all, and if it is acquired, see, if it is not depreciated at all, if it is goodwill profession acquired, then what will the cost of acquisition be, guys? Whatever is the actual cost of acquisition, you will take that. Do you agree? It is goodwill of business or profession, it is acquired, and it was not even depreciated. So what is the cost of acquisition you will take? You will take the actual cost of acquisition. If it is depreciated, what to do? Special treatment, we will see that later. Okay. If it is any other intangible asset, even here two things are possible. Other intangible assets, they may either be depreciated intangible assets, or if they are not used for my business or profession, then they will not be depreciated intangible assets. If they depreciated intangible assets, even today can I depreciate them? Yes, even today I can depreciate other intangible assets. Only goodwill of business or profession I can't depreciate today, but other intangible assets I can still depreciate. So other intangible assets, if they depreciated and if I sell them, what will you do? Any depreciable asset, when you sell, what do? You take it to monies payable. You take it to the block, less monies payable. Same treatment even over here, just like any other depreciable asset. But if it was not a depreciated asset, then what will the cost of acquisition be? It is not a depreciable asset, so which means I will not touch the block and all. Any other intangible asset acquired, not depreciable asset, what will the cost of acquisition be? Whatever the actual cost of acquisition is. There will be capital gains calculation here. There will be capital gains calculation here. Cost of acquisition will be the actual cost of acquisition. Till here, did you understand? Yes, guys, this is generally very, very confusing. A lot of times students get messed up here because of the huge amendment. So I'm trying to go a little slowly here, and I'm trying to, give you a sort of a flow chart so that you have crystal clear in this entire discussion. In case you're transferring an intangible asset, what am I talking about? In case you're transferring an intangible asset, what will you check? You will check, was it an acquired intangible asset or was it a self-generated intangible asset? If it is an acquired intangible asset, you will see, is it goodwill or any other asset? If it is goodwill of business or profession, either up to 1st April 2020, it might have been depreciated or it was not at all depreciated. If it is not at all depreciated, then you will take the actual cost of acquisition. That will be your cost of acquisition. Any other intangible asset may be depreciated, may not be depreciated. If it is depreciated, And if you sell it, you treat it just like any other depreciable asset sold. Take it to monies payable, you subtract. But in case it was not depreciated, then you will have capital gains. It's a capital asset. You will have capital gains. To compute capital gains, cost of acquisition will be your actual cost of acquisition. Okay, guys. Now listen. This part will come to this part later. What if it is self-generated? If it is a self-generated capital asset, you will see what kind of a capital asset is it. If it is a self-generated capital asset, you will see, is it a specified self-generated capital asset or is it any other capital asset? If it is a specified self-generated capital asset, then cost of acquisition will be 0 if it is self-generated. If it is any other self-generated capital asset, then no capital gains at all. No capital gains at all. What are these specified capital assets? Specified self-generated assets. Number one, goodwill. Goodwill of earlier, we just used to say goodwill of business, but today goodwill of business or goodwill of profession. Then earlier trademark, we used to say just trademark of business. Now trademark of business, trademark of profession, trademark or even brand name. Then number 3, we have tenancy rights, right to give a property on lease. Then number 4, we have route permits. Then number 5, we have loom hours. Then number 6, we have right to manufacture. Number 7, we have the right to carry on some business or profession. These are your specified self-generated assets. If your self-generated asset is a specified self-generated asset, cost of acquisition will be 0. Any other self-generated capital intangible asset, if you transfer, no capital gains at all. Till here also, did you understand? Yes, the only thing which is left for us to understand now is this part. Till here, did you understand? I'll pause here for a moment. Take a moment, try to absorb what just happened. See if you've understood till here. Yes, guys. Okay, now listen. Shall we focus on this part? I'll just run through this list. Goodwill of business or profession, trademark or brand name of business or profession, tenancy rights, route permits, loom hours, right to manufacture, right to business or right to do business or profession. Now listen, I am focusing entirely on this part. See, if you're going to acquire goodwill, whether goodwill of business or whether goodwill of profession, if you're going to acquire goodwill of business or profession on or after 1st April 2020, even if you want to, can you depreciate it? It is not depreciable. If you're going to acquire goodwill on or after 1st April 2020, it will always fall under which bucket? It will always fall under this bucket. But before 1st April 2020, it was a depreciable asset. It was a depreciable asset before 1st April 2020. So in case you acquired goodwill or profession before 1st April 2020, you would have depreciated it till 31st March 2020. In that case, what to do? Listen, our entire focus now is just on this part of the goodwill which was acquired before 1st April 2020. You will see on, you will see the opening WDV. You will see on 1st April 2020. Two things are possible. On 1st April 2020, you will look at the intangible assets block. Two things are possible. Thing number one, goodwill is the only asset in the block. Goodwill is the only asset in that intangible assets block. There is no other intangible asset in that block. In this case, point number one, you will just stop all block calculations that point onwards. That block will cease to exist. You imagine as if that block is not even existing anymore. You will see what is the opening WDV of that block. Opening WDV of that block on 1st April 2020. Later, whenever you transfer this goodwill, this opening WDV on 1st April 2020 will become your cost of acquisition. No more depreciation on that block. No more calculations in that block. It's as if that block has come to an end. Whatever is your opening WDV of that block on 1st April 2020, that will become the cost of acquisition later when you transfer that goodwill. Is this clear? This part also simple. When does a complication arise? Complication arises only if goodwill was not the only asset in the block, which means in that block, there is not only goodwill, there are other intangible assets also. In that case, what will you do? In that case, you will see what is the opening WDV of the block on 1st April 2020. From this, you will subtract the opening WDV of goodwill on 1st April 2020. Whatever balance number you get, this will become the revised opening WDV of that block on 1st April 2020. You go on now, life as usual with this opening WDV, depreciation, add actual cost of assets acquired, monies payable, life as usual. The question is, how will you calculate this opening WDV of goodwill on 1st April 2020? You imagine what if this goodwill was the only asset in the block? You imagine what if the goodwill was the only asset in the block? Then in that case, how would the depreciation be? Calculate deemed depreciation. Let us say long back you had acquired the goodwill. What was the cost of acquisition? For how much did you acquire goodwill? You subtract depreciation for all the years. You find the net number. Whatever number you get, that is going to become your deemed WDV of goodwill. You subtract that. So from the total opening WDV, if I subtract goodwill alone, then the balance will become the opening WDV of the other assets, guys. On this other opening WDV, I can continue to claim depreciation. The only confusion in your mind should be this calculation. Everything else should be clear. Again, I'll pause for a moment. Have a look at this. The only confusion in your mind right now should be this. This I will explain to you. You leave it on me. I'll give you examples and I will explain it to you. The rest of it you should understand perfectly. I'll give you a moment. Come on, run through it once. Done, guys. Does it make sense to you? I'll re-explain the entire thing to you once again at the end. Let me just finish this. See, this revised opening WDV number, two things are possible. It may be a positive number, it may be a negative number. Because I'm going to subtract something. It may be a positive number, it may be a negative number. If it is a positive number, I will continue with this WDV without any change. I will continue with this WDV, life as usual, any other block, how do you continue? You continue with this revised WDV. If it is a negative number, what will you do? Anybody? If it's a negative number, this negative number will be taxed as STCG, and for income tax perspective, you close this block. You understand, guys? For in case it becomes negative number, you treat that negative number as if it is STCG, and for income tax perspective, you treat as if this block has come to an end. Now, the only confusion in your mind is this opening WDV of goodwill, right? Let me explain this to you. Let us take an example. Let us say I had purchased the goodwill on 1st April 2018, I had purchased the goodwill for 1 lakh rupees. Okay, for 1819, and guys, listen, in this block, there are many assets. There is, let us say, goodwill, there is a trademark, there is brand name, there is some copyright. There are many assets in this block. It's a depreciable asset block, 25% intangible asset block, many assets in the block. And let us say the opening WDV of this block is 5,25,000. Okay, on 1st April 2020. Now from this, I have to remove opening WDV of goodwill. I will go back. When did I acquire the goodwill? I had acquired the goodwill long back on 1st April 2018. I had acquired it for 1 lakh. Now from this, I will imagine that this was the only asset in the block. If this was the only asset in the block, then 1819, how much depreciation you would have given me? 25,000. Then 1920, how much depreciation you would have given me? 75,000 into 25%, you would have given me 18,750. So on 1st April 2020, what would be the value of goodwill? What would the depreciated value of goodwill be on 1st April 2020? It would be 56,250. This 56,250 is the opening WDV of goodwill. Now you understood how I calculated this. I am imagining this is the only asset in the block. And if this was the only asset in the block, how would I calculate depreciation? So the net number would be 56,250. So now tell me, what's your revised opening WDV of this block? The revised opening WDV of this block will be 4,68,750. This is a positive number. So I will continue life as usual. This block will continue with 4,68,750 number. Later, this goodwill, when I sell later, this goodwill, now I will continue this block without goodwill. Okay, this goodwill, when I sell later, at that time, what will the cost of acquisition of this goodwill be? 56,250. Now understood. This 56,250 I have removed from the block, right? I will continue this block without goodwill. With all the other assets, I will continue this block with 4,68,000 revised opening WDV. Later, this goodwill, when I sell, can I touch monies payable? No, because this goodwill is not a part of the block anymore. So later when I sell goodwill, what will the cost of acquisition be? Cost of acquisition will be this 56,250 number, which is the opening WDV of goodwill on 1st April 2020. This will become the cost of acquisition later when I transfer this goodwill. This is our entire discussion regarding goodwill. Also, some of you must have understood this entire thing perfectly. Some of you would still be having a lot of doubts around it. I am going to re-explain this entire thing once again to you. This is complicated. This is taking us a little extra time. I think it's worth it. Listen to me. The way you guys are asking me questions in the chat box looks like you have not learned this properly already. Listen to me. Let me try to make it a little bit easier for you. We'll go once again point by point. In case of intangible assets, first of all, cost of improvement will always be 0. In case you acquired this intangible asset before 1st April 2001, you still don't have an option of taking actual cost of acquisition. You don't have an option of taking FMV number. You will stick to the actual cost of acquisition only. Now coming to the difficult point. Guys, listen, no doubt this point is very, very tricky, but I want you to try to listen to this point with a positive approach first of all. First of all, set aside the fact that this is difficult. First of all, bring in that urge, that want to try to understand it. You have to want to understand it. You should have the urge to understand it. Only then this part will get registered in your memory. Okay, so first of all, with a lot of positivity, let us begin. We will all understand it. Listen, in case I'm going to transfer the intangible asset, you will see, is it an acquired intangible asset or is it a self-generated intangible asset? Let us finish off the self-generated part first. That is easy. If it is a self-generated intangible asset, what will you see? If it is a self-generated intangible asset, you will see, is it specified self-generated or is it any other self-generated? If it is specified self-generated, then the cost of acquisition will always be what? Cost of acquisition will always be 0. In case it is any other self-generated intangible, then you will not even have any capital gains. Self-generated concept shall be set aside. This part is everybody thorough. I need everybody to participate. Next 5 minutes, come on guys, solid participation. This part we'll keep aside. Yes, if it is self-generated intangible asset, we will see, is it specified self-generated? If it is specified self-generated, cost of acquisition will be 0. Any other self-generated, I will not even have any capital gains. Okay, now let us come to the acquired part. In case it is acquired, we will see what kind of an asset is it. What kind of an intangible asset is it? Is it goodwill of business or profession, or is it any other intangible asset? Goodwill of business or profession, there only confusion. Let us keep that aside. We'll come to that later. If it is any other intangible asset, we will see, is it a depreciated intangible asset or is it not depreciated intangible asset? Now, listen, Finance Act 2021 said, goodwill of business or profession not depreciable anymore, but other intangible assets, I can still depreciate them. You agree? So in case they are depreciated asset, any depreciated asset I sold, what do you do? Less money is payable, block you adjust. Same thing you will do even over here. But if it was not a depreciable asset, if it is not a depreciable asset, a typical capital asset, whenever you sell a capital asset, not a depreciable asset, you have capital gains calculation, guys. Period of holding, full value consideration, cost of acquisition, all that you calculate. What will the cost of acquisition be? Whatever your actual cost of acquisition is. Tell me, if this cost of acquisition was before 1st April 2001, will you still take the actual cost of acquisition or will you compare with FMV? Do you have an option of comparing with FMV? You don't have an option of comparing with FMV. You will take only the actual cost of acquisition. Is this part also clear? This also I'll set aside. Okay, now everybody, this part is fine, right? Any other intangible asset, you will see, is it a depreciable intangible asset or any other intangible asset? If it is depreciable intangible asset, any other depreciable intangible asset you sold, what do? You do the calculations in the block, money is payable, same thing even over here. If it is not a depreciable asset, then like any other capital asset, cost of acquisition will be your actual cost of acquisition. Now listen to this part, guys. If it is goodwill of business or profession, then what will you do? If it is goodwill of business or profession, then you will see, was it depreciated or was it not depreciated? See, this point onwards, 1st April 2020 onwards, I'm going to acquire goodwill. Is it even possible to depreciate it? No. So either it may be not depreciated, never depreciated goodwill, or it may be goodwill which was depreciated once upon a time. Okay, if it was not depreciated, never depreciated goodwill, then simple. What will the cost of acquisition be? The actual cost of acquisition. Even this part is fine. Okay, now listen to this part. This is where the whole confusion is. Now I can't depreciate it. But what if once upon a time it was depreciated? Then what will you do? Once upon a time, if it was depreciated, you will see you will go back, you will rewind and you will go back to 1st April 2020. You will see on 1st April 2020, see why are we going to 1st April 2020? Because 1st April 2020 onwards, it is not a depreciable asset. Everybody understood? 1st April 2020 onwards, it is not a depreciable asset. So, in case once upon a time it was depreciated, I will go back to 1st April 2020. On 1st April 2020, I will look at the intangible assets block. In the intangible assets block, is goodwill the only asset in the block, or in the intangible assets block, there are many assets including goodwill? Till here also understood. In case it was depreciated once upon a time, if it was depreciated, I will rewind, I will go back to 1st April 2020. 1st April 2020, I will look at the block. Why will I look at the block? Obviously, it was depreciated once upon a time. So I will look at the block. Depreciated means I will look at the block. So on 1st April 2020, I will look at the block. Is it the only asset in the block, or are there other intangible assets also? If it was the only asset in the block, then what will you do? Then you will ignore this block, this point onwards. No depreciation, no block calculations this point onwards. Whatever is the opening WDV on 1st April 2020, that becomes a cost of acquisition later whenever you transfer. This part also fine. This part also fine, guys. If goodwill is the only asset in the block, then you stop the block calculations. No depreciation anymore, because 1st April 2020 onwards, goodwill is not depreciable anymore. Whatever is the opening WDV on 1st April 2020, that becomes a cost of acquisition. Now comes the drama point. Listen. Goodwill is not the only asset in the block. There are many other assets in the block. The amendment, is it for all the intangible assets? No. The amendment is only for goodwill. So, from all the intangible assets, I'll separate goodwill. Because on balance, I can continue with life as usual. On the balance, I can continue with depreciation. So from my opening WDV on 1st April 2020, this opening WDV includes all intangible assets, guys. From this opening WDV on 1st April 2020, I will remove opening WDV of goodwill, balance opening WDV. This I can continue life as usual. If this balance opening WDV is a positive number, I will continue to claim depreciation on this opening WDV number. Just like any other block, I will continue as usual. But this number might be negative. Why negative? Because I'm subtracting something. So what if this number is more than this number? Then I might have a negative number. If I have a negative number, then this negative number will become STCG and my block will come to an end. Story over. Till here also you understood. If this becomes a negative number, then this negative number will become STCG, block will come to an end, no more depreciation, story over. So what is the only thing we are left with now? The only thing we are left with is this opening WDV of goodwill. How will we find? See, opening WDV on 1st April 2020 of this block we already have. From that opening WDV, we are supposed to remove opening WDV of goodwill, because on the balance opening WDV, I can continue to claim depreciation. So on this balance opening WDV, I'll continue. If it's a positive number, I'll continue to claim depreciation life as usual. How will I find the opening WDV of goodwill? How will I subtract opening WDV of goodwill? For a moment, I will go back. I will see when did I acquire this goodwill. I acquired this goodwill on 1st April 2018 for 1 lakh. I will imagine what if this was the only asset I had. Then for 18, guys, goodwill, depreciation rate. At what rate we would have depreciated? Okay, today it is not depreciable, but 18, 19 and all, what rate we would have depreciated? All intangible assets, 25% we depreciate. So even this we would have depreciated at 25%. So for 18, 19, 25% we would have depreciated. WDV basis. So 75% WDV. 1920, how much we would have depreciated? Again 25%, 18,750. So on 1st April 2020, what is the value of goodwill? 56,250. This calculation, now you understood. On 1st April 2020, what is the value of goodwill? 56,250. Okay, now we will see what was the opening WDV of the block on 1st April 2020. In my example, opening WDV was 5,25,000. This opening WDV is all intangibles put together. From this, I will remove goodwill alone. What's the goodwill WDV we calculated? 56,250. I'll remove the goodwill WDV alone. Now, this balance WDV will be for rest of the assets. Do you agree? It's a positive number. So what will I do with this positive number? I'll continue with depreciation on this positive number, life as usual. I removed goodwill. This goodwill number I removed. What will I do with this goodwill number? On this goodwill number, no depreciation. Later, whenever I sell away the goodwill, this number will become the cost of acquisition. Now understood. Now 100% clarity. Now you will not make a mistake. Yes. Perfect, guys. Now, one last flowchart, please. One last flowchart we'll make. That flowchart will give us all the clarity. Okay. Listen. Just one last flowchart on goodwill. I'm talking just about goodwill. Okay. Whether goodwill of business, whether goodwill of profession. If this goodwill of business or profession was self-generated, then what will cost of acquisition be? Then cost of acquisition will be 0. Okay. Then what if this goodwill of profession is acquired goodwill? You will see when was it acquired. Was it acquired before 1st April 2020 or was it acquired on or after 1st April 2020? It was acquired on or after 1st April 2020. Tell me, is it even possible that it was depreciable? On or after 1st April 2020 means it's definitely not depreciable. If it's not depreciable, then tell me, what will the cost of acquisition be? The actual cost of acquisition. It was acquired before 1st April 2020. Two things are possible. What are the two things possible? It might have been depreciable. It might never be depreciable. If it was not depreciable, even here simple, what will the cost of acquisition be? The actual cost of acquisition. But it was depreciable. Once earlier it was depreciable. Then what will the cost of acquisition be? This you answer. If you answer this, I'm satisfied. If it was depreciable once upon a time, then what will the cost of acquisition of this goodwill be? whether it was the only asset in the block, whether there were many assets in the block, depreciable asset, if it's depreciable, cost of acquisition will be opening WDV on 1st April 2020. Now story over. Now fine. Yes, so whether depreciable, if it was depreciable, whether it was the only asset in the block, if it was the only asset in the block, even then opening WDV on 1st April 2020 would be cost of acquisition. There are many assets in the block, even then opening WDV on 1st April 2020, this would be the cost of acquisition. Shall I close the story now? Yes, we spent quite a lot of time here. Shall we go to the next discussion? Okay, this was our entire discussion on intangible assets. Now everybody is convinced. Is everybody confident about this discussion? You will be able to handle it. Just do me one small favor, okay? Once we finish this session, no matter how late it is, spend another maximum 15 minutes running through this entire discussion on goodwill and you will be set. Okay, now listen. Let me take you to the next adjustment. Finally, let's go to the next point. Point number Q, my next adjustment. This time I'm talking about advance money forfeited. In case any advance money is forfeited, does any date come to your mind? Advance money forfeited, does any date come to your mind? If advance money is forfeited, you will see when was the advance money forfeited. Was it forfeited before 1st April 2014 or was it forfeited on or after 1st April 2014? If it was forfeited before 1st April 2014, what will you do? Right now, nothing you will do. Later, whenever you transfer the capital asset, at that time, from the cost of acquisition, you will subtract the advance money forfeited. You will get the balance number. This number only you will index. You agree with me? But in case it was forfeited on or after 1st April 2014, then what will you do? In the previous year of forfeiture, in that year itself, it will be taxed under the head IFRS. Simple. Then tell me, advance money forfeited by previous owner. Will you consider this? Cost of acquisition, I'm talking about 49 subsection 1 cases, okay? In 49 subsection 1 cases, cost of acquisition is previous owner's cost of acquisition. Period of holding includes previous owner's period of holding. Cost of improvement includes previous owner's cost of improvement. Will advance money forfeited by previous owner also will you consider? No. Advance money forfeited by previous owner, you will not consider. Everything else you consider of the previous owner also. Advance money alone, you do not consider of the previous owner. Is this clear, guys? Yes, come on, one quick revision. In case you forfeited the money before 1st April 2014, then from the cost of acquisition, we will subtract the advance money forfeited. The balance number you get, that number only you will index. When will you do all this calculation? You will all do all this calculation only in the previous year of transfer. Later, whenever we transfer the property, in that year, you will be calculating the capital gains. In that year, you need cost of acquisition. That time from cost of acquisition, you will subtract advance money forfeited before 1st April 2014. This net number only you will index. In case it was forfeited on or after 1st April 2014, then what will you do? In the year of forfeiture, in the previous year of forfeiture itself, it will be taxed under the head IFRS. Then we learned whenever 49 subsection 1 applies, we always consider previous owner's cost of acquisition, previous owner's period of holding, previous owner's cost of improvement, but advance money forfeited by previous owner, we will not consider. Simple. Yes, now I'll take you to the next discussion. My next discussion is applicable to a very, very special situation. Here, my assessee happens to be a non-resident. The capital asset are unlisted securities of Indian company. Long back when this assessee had acquired these unlisted securities, he had acquired them using foreign currency. Okay, if this situation arises, then what is the concept you already know? If the assessee is a non-resident and if the capital asset is something which is unlisted securities of an Indian company which he had acquired long ago in foreign currency, then what is the concept you already know? Concept number 1, you already know that there will be no indexation. Even if it is a long-term capital asset, there will still be no indexation. Concept number 2, listen, unlisted security. So, even if it is long-term, even if it is short-term, no indexation, fine. The second point is the entire computation you will do in which currency? Entire computation you will do in foreign currency only. After you do the computation in the foreign currency, this computed number, you will find the capital gain number also in foreign currency only. After computing the capital gain number, then only you will convert into INR. All right, two simple points, not very important for your intermediate examination, but it is a part of your syllabus, hence you should know about it. So number one, no indexation benefit, whether short term, whether long term, no indexation benefit. Number two, whatever computation you're doing, entire computation you will do in the same foreign currency only. After doing the calculation in the foreign currency, the final number that you have, that final number you will convert into INR. You will not do the calculation in INR. Calculation will be in foreign currency only. The final capital gain number will be converted into INR. This was a simple situation. Now coming to my next situation, I think my next, no, not the last situation. We are almost towards the end of the special situations. My next situation is about slump sale. Slump sale, please listen carefully. This is one of the most important situations for upcoming examination. What exactly is slump sale? First of all, in slump sale, I am going to get lump sum consideration. In slump sale, do I give separate value for each asset? No, in slump sale, we do not give separate value for each asset. Instead, what we do over here is we sell the entire undertaking itself. We sell the entire unit itself. We sell the entire branch itself. We sell the entire division itself for a lump sum consideration. Here, we do not allot separate consideration for each asset. Answer my question. Slump sale, what will the relevant period of holding be? 12, 24, 36 months. What will the relevant period of holding be? The relevant period of holding will be 36 months. If it is more than 36 months, then it's going to be long-term capital asset. If the undertaking existed for more than 36 months, then it will be a long-term capital asset. Then slump sale, if it is long-term, will you do indexation of the cost of acquisition? No, you will not get any indexation benefit. Then number 4, what will cost of acquisition plus cost of improvement be in such cases? Cost of acquisition plus cost of improvement will nothing be the net worth. It will be nothing but the net worth of the undertaking. How will you calculate this net worth? Net worth will be nothing but the total assets of the undertaking minus the total liabilities of the undertaking. The net worth will be nothing but the total assets of the undertaking minus the total liabilities of the undertaking. When you're calculating the total asset, in case any asset is revalued, what will you do with the revaluation? You will not consider the revaluation. You will ignore the revaluation. In case any of these assets are those assets for which you have claimed 3580, you've already claimed. For those assets, how much value you will take? If the asset is an asset for which you have claimed 3580 deduction, for that asset, what value you will take? For that asset, you will take 0 value. In case it is a 3580 asset, you will take 0 value. Okay, then what will the full value consideration be? Full value consideration will be not the actual lump sum consideration, not this number. Full value consideration will be the FMV number. This is an amendment. I hope you're aware of this amendment. It is applicable for November 2022. What will the full value consideration be? The FMV. FMV of what? It will be FMV of the consideration which we are receiving, or FMV of the unit which we are selling. Out of these two FMVs, which FMV will we take? We will take whichever is higher. FMV of what we are getting, FMV of the unit which we are transferring, whichever is higher, that's going to be the full value consideration. Okay, now in one more point guys, when you're looking at these total assets, if you have, let us say, self-generated goodwill of business, self-generated goodwill of profession and all, what value will you take? Self-generated goodwill of business or profession, you will take 0 value. In case any asset is depreciable asset, then what number will you take? If it's depreciable asset, you will take the WDV number after depreciation. Is my entire slump sale discussion clear? Shall we run through the concepts once again, guys? What happens in slump sale? In slump sale, I do not allocate separate value for each asset. In slump sale, for all the assets put together, for the entire undertaking, a lump sum consideration is allocated. Here, the relevant period of holding will be 36 months. Here, even if it is long term, still there will be no indexation benefit. Then we learned cost of acquisition and cost of improvement will be nothing but the net worth number. And net worth is nothing but total assets minus total liability. When you're calculating the assets, in case any asset is revalued, you will ignore the revaluation. In case any asset exists on which you have claimed 3580 deduction, that asset you will take 0 value. In case you have any self-generated goodwill of business or profession, for that also you will take 0 value. In case you have any depreciable asset, for depreciable asset, what value you will take? For depreciable asset, WDV value is what you will take. Okay, then we learned how will we calculate the full value consideration. Full value consideration will be the FMV of the consideration, FMV of what we are getting, consideration, or FMV of the unit which we are transferring, whichever is higher. Perfect understanding, guys. Can I take you to the next concept, the next special situation? Listen, my next situation is going to be a very special situation wherein my capital asset being transferred is land and building. Capital asset being transferred is land and building, and the full value consideration is separately given for land and separately given for building. If you are selling land and building, for example, let us say property is being sold, this entire building is being sold, and separate consideration for land I'm charging, separate consideration for building I'm charging, then what will you do? You will treat them as, you will do two separate calculations, you will treat them as two separate assets. If you have, I'm selling the entire property, I'm selling a building, and I'm asking you different consideration for land. I'm saying for land 10 lakh, for building 10 lakh. Separate considerations are being allocated to land and building. What will you do? You will calculate as if they are two separate assets. But what if for land and building put together, what if I say together I'm going to charge aggregate 20 lakhs? In that case, you will treat building as cost of improvement. Understood, guys? In that case, building will become cost of improvement. You will have only one single calculation. Did you understand this discussion, everybody? In case for land and building, two separate considerations are given. Then you will treat them as if they are two separate assets and two separate calculations, two separate periods of holding, two separate calculations you will have. But in case for land and building put together, one single consideration is given, you will treat as if it is one single capital asset. You will treat as if the building is cost of improvement. You will have one single capital asset, one single period of holding, one single calculation. Okay, this is only from calculation perspective. Now listen to my next situation. What if the securities are being bought back? What if there is a buyback of securities? If it is a buyback of securities, you see, first of all, which security is being bought back? Is the security shares? Shares, whether they are listed or unlisted, I don't care. Are the securities being bought back? Are they shares? And that too shares of a domestic company. If they are shares of a domestic company, then for the shareholder, any capital gains, guys? For the shareholder, there will be no capital gains. The entire tax implications will arise for whom? Only for the company. And the company will have to pay what? Company will have to pay buyback distribution tax. This buyback distribution tax will be what percentage? Anybody? What's the percentage of buyback distribution tax? 20%. 20% of what? 20% of the distributed income. What is distributed income? Distributed income will be nothing but whatever the buyback price is from the buyback price minus the issue price. What is buyback price? Buyback price is at what price is the company buying back the shares. What is issue price? Long back when the company had issued the shares, at what price did the company issue the shares? So buyback price minus issue price will be the distributed income. On the distributed income, 20% will be the buyback distribution tax. You have to mandatorily add surcharge. Surcharge at what rate? Irrespective of the amount, you have to mandatorily add surcharge at 12%. You have to mandatorily add cess at 4%. So in case the shares that are being bought back, are shares listed or unlisted of domestic company, then for the shareholder, there will be no capital gains. The company will have to pay buyback distribution tax at what rate, guys? At 20%. Just a moment. %20 of what? 20% of the distributed income. What is distributed income? The buyback price minus issue price plus mandatory surcharge at 12% and cess at 4%. Let me give you an example. Let us say my shareholder had purchased my shareholder, for him cost of acquisition is, let us say, 12 rupees. Okay. The face value of the share is, let us say, 5 rupees. The company had issued the shares. Long back when the company had issued the shares, company issued the shares at a premium of 3 rupees. And today the company is buying back the shares at, let us say, 20 rupees. My question to you is, calculate and tell me what is the distributed income. In domestic companies shares, for shareholder, no capital gains. Company has to pay buyback distribution tax. Buyback distribution tax 20% plus surcharge 12% plus cess 4%. All this is fine. I want you to calculate the distributed income and tell me what will the distributed income be. Perfect answer. Distributed income will be 12 rupees. How 12 rupees? What is the buyback price? Tell me. The buyback price is 20 rupees. What was the issue price? Long back when the company issued shares, at what price did the company issue? 5 rupees face value plus 3 rupees premium, 8 rupees. So what is the distributed income? The distributed income will be 12 rupees. On this 12 rupees, you will calculate 20%. That will be 2.4. 2.4 plus 12% plus 4%. So you will get 2.8. 2.8 will be the buyback distribution tax. You understood? 20% of distributed income will be your buyback distribution tax. On that surcharge 12%, on that cess 4%. So you will get 2.80 as buyback distribution tax. Okay, this is what if it is shares of domestic company. What if it happens to be shares of foreign company? What if it happens to be any other security? For example, debentures of Indian company, debentures of foreign company. What if it happens to be any other security of domestic company or foreign company? In that case, for shareholder, there will be capital gains. Normal, usual calculations, guys. It will be as if the shareholder has sold it to the company and company is giving compensation. If it happens to be any other security as in here we are covering only shares of domestic company, guys. Any other security means what? Any other security means it can be shares of foreign company, or it can be other security like debentures and all of domestic company, foreign company. If it is any other security, then what will you do? Any other security, then you will put it under the second bucket. In any other security, the company will not have to pay any buyback distribution tax. For the company, there will be no tax implications at all. For the company, there will be no tax implications at all. For the shareholder alone, there will be capital gains, and these capital gains will be normal, usual capital gains. How do you generally calculate capital gains? Full value consideration minus cost of acquisition. So what will be the full value consideration in this case? It is buyback. Company is taking away your securities. Will you give it to the company for free? No, right? Company will be giving you buyback price. That buyback price will be your full value consideration. Cost of acquisition, whatever you actually spent. You treat as if you're selling away your securities to the company. This is a discussion regarding buyback. All right. So with this, guys, all our special situations we are done learning. We began our discussion with section 45, charging section. Then we learned about capital asset meaning, section 2, clause 14. Then we learned about short-term, long-term capital assets, period of holding and all we learned. Then we learned about transfer, section 2, clause 47. Then we learned about section 48, the entire computation mechanism. And then we started learning about all the special situations one by one. All the special situations, are we clear, guys? Yes. So this was our discussion regarding the special situations. Now listen, in entire capital gains, in your CA intermediate, you are supposed to know about 2 case laws. What are the 2 case law names you should be knowing? Manjula J. Shah and number 2, Arun Shunglu Trust. There are 2 case law names which you should be knowing, Manjula J. Shah and Arun Shunglu Trust. Now, in both these case laws, what did the lawmaker conclude? What did the court conclude? The court concluded that even in section 49(1) cases, even in 49 subsection 1 cases, when you index the cost of acquisition, how do you index? Cost of acquisition into CII of the year of transfer divided by CII of the year of acquisition. This acquisition will be whose acquisition? Which year? Whose acquisition? You will take the previous owner's year of acquisition. Okay, so we have Manjula J. Shah and Arun Shunglu Trust. In both these cases, the conclusion was the same. The conclusion was that we will be in 49 subsection 1 cases. In 49 subsection 1 cases, the CII of the year of acquisition will be the CII of the year in which the previous owner had acquired the asset. All right, so this was our discussion regarding Manjula J. Shah and Arun Shunglu Trust. Okay, now listen, guys. One more point I want to discuss with you. Point number 7. Section 4.5 When does 4.5 apply? 4.5 applies in specified agreements. What are these specified agreements? Specified agreements, nothing but joint development agreements. Specified agreements, nothing but joint development agreements. What happens in a joint development agreement? See, this particular point, I'll quickly try to summarize, okay? This particular point in full detail, I've explained in the RTP MCQ discussion. Okay, you will find the RTP video on my YouTube channel. That RTP, the MCQ video, the first RTP, part 1 of the RTP discussion, the first question itself, in full detail, I have discussed this. Okay, I'll just give you a quick summary of this. Section 45, subsection 5A, specified agreements, joint development agreement. What happens here? The owner and the developer, two people in the story. Owner gives his property to the developer. In return, what does the developer give the owner? In return, the developer gives the owner some cash plus a share in the new property. What does the developer do with this property? This is an old property. The developer will develop this property. For example, this property was having 3 floors already. The developer will, deconstruct the property, and then let us say the developer freshly develops 5 floors. And out of the 5 floors, let us say he gives the owner 2 floors. So in joint development agreements, this owner will always get a share in the new property. Cash is optional. He may get cash, he may not get cash, but he will for sure get share in the new property. What did the developer earn out of this then? Earlier, there were 3 floors. The developer deconstructed these 3 floors. He constructed 5 floors, and out of the 5 floors, let us say he gave 2 floors to the owner. So the developer is still left with how many floors? He is still left with 3 floors. These 3 floors he is selling to the outsiders, and that is the money which he makes. 4.5 is from whose perspective? From owner's perspective or from developer's perspective? Come on guys, tell me. 4.5 is from the owner's perspective. For the owner, there will be capital gains. But for the owner, the previous year of transfer will be what? The previous year of transfer will be the previous year in which we transferred the possession to the builder. We will see when did we transfer the possession to the developer. That will be the previous year of transfer. But when will you tax the capital gains? When will we tax the capital gains, guys? We will tax the capital gains only in the year in which we got the construction completion certificate. All right. See, guys, same rule. Generally, what do? Previous year of transfer. In that year itself, we tax the capital gains. But in joint development agreements, what will you do? In joint development agreements, previous year of transfer will be what? Previous year of transfer will be the previous year in which we transferred the possession to the builder. But when will we tax the capital gains? We will tax the capital gains only in the year in which we get the construction completion certificate. Same like where else did we see these exceptional cases? We saw these exceptional cases in liquidation. Then where else we saw these exceptional cases? In conversion of capital asset into stock in trade. Where else we saw these cases? Insurance compensation. And last we had seen this case, this similar thing in compulsory acquisition. Thorough till here? Yes, 4.5 what are we talking about? Specified agreements. We're talking about joint development agreements. The owner is giving the possession of his property to the developer. In return, the developer is giving him what? In return, the developer is giving him cash. Cash is not mandatory, but what is mandatory? Mandatory, he's going to get a share in the new property. Okay, so for the owner, there will be capital gains. We're talking from the perspective of the owner. For the owner, there will definitely be capital gains, right? But this capital gains, when will the transfer happen? The transfer will happen in the year in which he gives away the possession of the property to the developer. But when will it be taxed? It will be taxed only in the year in which we get the construction completion certificate. Now tell me, for the owner, what will the full value consideration be? What will the full value consideration be? Full value consideration will be whatever cash he is getting, plus this share in the new property. Share in the new property, how will you calculate? Share in the new property, how will you calculate? You will take the SDV number. SDV number on which date will you take? SDV number on the date on which we got the construction completion certificate. Is this also clear? Okay, then this share, now listen, these 2 floors, who is the owner of these 2 floors now? This owner. What is this owner later sells away the share. When he sells away this share, capital gains will arise. When he sells away this share, capital gains will arise. What will the cost of acquisition be? What will the cost of acquisition be? Earlier in full value consideration, we had put this SDV number. That same SDV number at construction completion certificate date will become the cost of acquisition. All these concepts practically with numbers, with detailed explanation, you will find in the RTP first part, first MCQ, first question discussion itself. Provisions I've anyways explained here. You understood the provisions, guys? One last revision of the provisions. Listen, which section are we talking about? We're talking about section 45, subsection 5A, specified agreements, joint development agreements. We have a person who owns a property. This owner has given away his property to the developer. In return, cash he may or may not get, but he will for sure get a share in the new property. This share in the new property and cash he's getting, there will definitely be capital gains in the hands of the owner. The why capital gains? Because he's transferring property, right? He's transferring his property, he's getting compensation. This will be capital gains. There will be transfer. When will the transfer arise? Transfer will arise in the year in which we give the possession to the developer. But when will we tax the capital gains? Only in the year in which we get the construction completion certificate. Okay. Then we learned that for the owner, when you calculate capital gains, what will the full value consideration be? Full value consideration is nothing but whatever he is getting. What is he getting? He is getting cash plus share in the new property. Cash, fine, we'll take as how much ever it is. Share in new property, how will you calculate? Share in new property, you will take the SDV number. SDV number on which date will you take? SDV number on the date of construction completion certificate you will take. Okay, now this new property, this person has become the owner. Later when he sells away this property, at that time, capital gains will arise. What will the cost of acquisition be? Cost of acquisition will be whatever SDV number was included in FPC earlier, the SDV on the date of construction completion certificate, that will be the cost of acquisition. Vinayak is asking, at this time, no cost of acquisition. No, Vinayak, at this time, there will be cost of acquisition. At this time, cost of acquisition will be, what is he selling? He's selling his property to the developer, right? How much did he acquire this property for? How much did he acquire this property for? That will be the cost of acquisition, right? See guys, there are two transfers I'm talking about. Two transfers. This is the first transfer and this is the second transfer. Nobody's getting confused, right? What is the first transfer? The first transfer is whatever property we are giving to the developer. Owner is giving away his property to the developer. In return, he is getting cash plus share in new property. This is the first transfer. For this first transfer, full value consideration will be cash received plus whatever is a share in the new property. Okay, then what's the second transfer? The second transfer is we have share in the new property. This share we are selling away. Okay, this share in the new property we are selling away. This is the second transfer. When we sell away this share, when we sell away this new property, capital gains will arise. What will be the cost of acquisition? Whatever is the SDV in this full value consideration. In this full value consideration, whatever is the SDV on the date of construction completion certificate, that itself will become the cost of acquisition. Manasa is asking us a very relevant question. Why are we not taking cash? Because there is ambiguity. The law simply says the cost of acquisition will be FPC number. Whatever is the FPC number, that will be the cost of acquisition. That is what the law says. Okay. But then the general view which we follow even practically is that we do not consider the cash component number. We take only the SDV number. So whatever was the SDV in this FPC component, that number only will become the cost of acquisition later when we sell. The SDV on the construction completion certificate date, that itself will become the cost of acquisition. There are two views. There are actually two views. One view is you take this FPC number itself as it is, you take the FPC number itself. That is one view. Okay. But the second view and the more practical view is you will take the SDV. What is the SDV number in this FPC? SDV on the date of construction completion certificate date, that itself will become the cost of acquisition. Period of holding in both the cases will be the actual number only. I've already discussed with you. The date of transfer will be the date on which you give away the possession to the developer. That is when the date of transfer will be. For the second, so basically for the first transfer, period of holding will be whenever you acquired the property till when are you giving away the possession to the developer. Monica, till here understood? For the first transfer, you understood? First transfer, the period of holding will be when did we give the possession to the developer? Till when did we give the possession to the developer? For the second property, for the second transfer, for the new property, the period of holding will start when you got the construction completion certificate. On that date, the period of holding will start. It will end when? It will end whenever you are transferring the property. Understood, Monica? So for the first transfer, the period of holding will be whatever is the date of acquisition till the date of giving possession to whom? Till the date of giving possession to the developer. For the second transfer, period of holding will start when? Period of holding will start on the construction completion certificate date, and it will end when? It will end on the date of transfer, whatever it is. Now got it? Okay, so this was section 4.5 E. Any confusion? Anybody? Can I proceed further? Yes. Now after this, we have to learn about two more things. We have to learn about all the exemption sections, and then we have to learn also about the taxation part. All right. Shahid is asking, on the developer, any section will apply. On developer, only one section will apply, which is section 194 IC, TDS section. The developer, when he's giving you the cash component, Shahid, are you following? When the developer gives you the cash component, on this cash component, the developer will deduct tax under section 194 IC at what rate? At 10%. There is no limit, no 50 lakh limit and all here. Irrespective of the amount, on the cash component alone, 10% tax he will deduct at source. Okay, so this was 4.5.5A. Okay, guys, now after this, we have to learn about all the exemption sections one by one, and then we have to learn about the computation sections. Shall we begin? Shall we take a small 5 minutes break otherwise? I think my throat is getting too tired. Let's take a small exact 5 minutes break and we will resume. All right. I am back. Are you back? Shall we resume? Yes, guys. Are you feeling refreshed? Another half an hour, 45 minutes. I know I'm extending, but please stay. All right. I want to finish off the rest of the discussion. Okay. So listen, until now, what have we learned until now under capital gains? All the special situations, are you confident? Tell me. All the special situations, especially the depreciation, the goodwill part. 100% confident. Very good. And what about the 4.5 part? 4.5 part, just for my own satisfaction, one last time, shall we see it quickly? Listen, in 4.5 we said for the owner, there will be two transfers. Number one, when he's transferring the property to the developer, okay, at that time, what will be the date of transfer? Date of transfer is when he gives away the possession to the developer, but it will be taxed when? It will be taxed only in the year in which the construction completion certificate is received. When you're computing these capital gains, full value consideration will be whatever cash he has received plus whatever is the SDV of the new property which he's getting. SDV on which date? SDV on the construction completion certificate date. Okay, then we learned for the second transfer, this share in new property, what if he sells it later? Then what will the cost of acquisition be? Whatever was the STV on the date of construction completion certificate, that is whatever was the FPC earlier, that will also become his cost of acquisition later. Okay, now listen guys, let me take you to the next discussion. We're going to be learning about the exemption sections. Totally, there are 5 exemption sections that we have to learn about. Okay, this part of the discussion is important. Listen carefully. I will try to simplify this for you as much as I can. The very first exemption section we are going to be learning about is section 54. If I talk about section 54 exemption section, we'll go point by point. Who is my assessee over here? My assessee is an individual or a HUF. Okay. What is a capital asset that this assessee has transferred? This assessee has transferred a residential house property. A residential house property which is assessed to tax under IFHP. Guys, it should be a residential house property which is assessed to tax under IFHP. This means if the house property was still under construction, then tell me, will it be assessed to tax under IFHP? If it is still under construction, it will not be assessed to tax under IFHP. So if you're selling that property, will you apply 54? No. If you're applying section 54 means, number one, it should be a residential property. Residential as in it should not be a commercial property. And this property should be assessed to tax under IFHP, which means it should either be a let out property or a self-occupied property or an unoccupied property, but it should be taxed under the head IFHP. If it is still under construction, then it will not be, you will not do any calculation under IFHP as of now. So that property, section 54 will not apply. Okay, number 3, the third point, you're transferring this capital asset, right? Because of transferring this capital asset, what kind of capital gains are you earning? You are earning long-term capital asset, long-term capital gain. Okay, and what is a new asset that you are purchasing? You are purchasing another residential house property. How many residential house properties you can purchase? Generally, only one. But once in the lifetime of the assessee, I will allow him even 2 properties. But in that case, the LTCG should not be more than how much? In that case, the long-term capital gain should not be more than, anybody? LTCG should not be more than 2 crores, right? So generally, I will let you buy only one residential house property, and that too, this residential house property should be where? This residential house property has to be in India. Generally, I will let you buy only one residential house property in India. But once in the lifetime of my assessee, I will let him take exemption for even 2 house properties in India, but only if his LTCG is not more than 2 crores. Okay, then to purchase this new asset, what is the time limit? If you're going to purchase the property, when can you purchase? From the date of transfer, either you can purchase within 1 year before the date of transfer, or you can purchase within 2 years after the date of transfer. In case you're constructing, then from the date of transfer, within how many years? Within 3 years. Within 3 years, you should do what? Within 3 years, you should complete the construction. I don't care when you started the construction, you should complete the construction within 3 years from the date of transfer. Is this point crystal clear? Yes. Now, this new asset, what is the lock-in period of this new asset? How long should you keep this new asset? You should keep this new asset for 3 years. Now, what if you do a violation? What if you sell away the property in this 3 years itself? Then, when you sell away this property, when you sell away the new asset, again capital gains will arise, right? To calculate capital gains, you need cost of acquisition. Cost of acquisition will be the actual cost of acquisition minus section 54 exemption which you claimed already. This is my entire discussion regarding our first exemption section, section 54. Did we understand this, guys? Section 54, one quick revision. My assessee should be an individual or a HUF. What is a capital asset over here? A residential house property. He's transferring a residential house property which is assessed to tax under IFHP. And what is he buying? He is buying one residential house property where one residential house property in India. So he's selling a residential house property and he's buying a residential house property. Long-term capital gains. He must be buying only one residential house property in India. But once in his lifetime, if LTCG is not more than 2 crores, I will let him buy 2 properties also. Then we learned what is the time limit. When should you be buying this new asset? If you're purchasing, you must be purchasing 1 year before transfer or within 2 years after transfer. In case you're going to construct, you must complete the construction within 3 years from transfer. This new asset lock-in period is going to be 3 years. That is, this new asset you have to keep with yourself for 3 years. In this 3 years, what you should not do, guys? In this 3 years, what should you not do? In this 3 years, you should not sell away the property. In this 3 years, you should not transfer the property. What if you do a violation? What if you sell off the property in these 3 years? Then from if you sell away the property, if you're going to sell away the house, you'll have capital gains, right? For capital gains, you need cost of acquisition. From the cost of acquisition, you will subtract the section 54 exemption, which you have enjoyed already. All right, then over here, capital gains deposit account scheme will apply. What is capital? When does this apply? When does the capital gains deposit account scheme apply, guys? See, listen, you're going to purchase the new asset. You have so much time to purchase a new asset. If you're going to purchase a new asset after your 139(1) due date, After you file the income tax return, only after that, if you're going to purchase a new asset, then what will you do? In that case, whatever money you're going to spend for the new asset, you will put into capital gains deposit account. Did you understand this point, everybody? I'll repeat again. If you're going to be purchasing the new asset, right? You're going to be purchasing the new asset. The new asset, if you're going to acquire or if you're going to construct after section 139(1) date, after your income tax return date, if you're going to acquire or construct, then you will have to put the money into capital gains deposit account. Whatever money you put into capital gains deposit account, that money 54 exemption we will get. When will we come back to this account? When will we revisit this account? From the date of transfer, we will add 3 years. After 3 years, we will revisit this account. On this date, we will see how much money is still unutilized in this account. Whatever money is still unutilized in this account, it will be taxed as LTCG. I'll give you one example to help you understand capital gains deposit account. Understand it properly here, because rest of the sections, it will all be similar to whatever you're learning here. Let us take an example. Let us say the previous year in our question is previous year 21-22. Let us say 139(1) due date applicable for this year is 31st July 2022. My assessee has transferred the asset. Date of transfer, he's selling away a residential house property which is assessed under IFHP. He's selling it on 31st October 2021. Okay, by selling this, he wants to acquire a new property, but he wants to acquire new property only after 31st July 2022. How much time does he have to acquire? He has 2 years time after transfer to acquire, right? You remember I told you, you can acquire within 2 years after transfer. So he has 2 years time to acquire after transfer, so that he has time till 31st October 2023. He has so much time. So he wants to acquire only after 31st July 2022. So what will we tell him? We will tell him whatever money you think you're going to be spending for the new house, you go to a scheduled bank, you open a separate bank account there, call it capital gains deposit account, and you deposit that money into capital gains deposit account. When will he transfer into capital gains deposit account? Let us say he has transferred 2 lakh rupees into capital gains deposit account. When should he transfer? He should transfer on or before his income tax return, before 31st July. Okay, what he did is he transferred 2 lakh rupees into capital gains deposit account. Out of 2 lakh rupees, 1,75,000 rupees he used for the new residential house property. You tell me, when will we come back to this capital gains deposit account? Let me give you some extra information. This money was transferred into capital gains deposit account on 30th July 2022. Now tell me, when will you revisit this capital gains deposit account? When will you come back to this deposit account? I'll give you 3 options. 31st October 2021 plus 2 years, which is 31st October 2023, or 31st October 2021 plus 3 years, which is 31st October 2024, or 30th July 2022 plus 2 years or 3 years, as the case may be. Which option do you think is right? It is a second option. You will revisit only after 3 years. Why 3 years? Because section 54 has 2 time limits, which is a bigger time limit, 3 years. So only after 3 years you will come back. On 31st October 2024, how much money is still unutilized in this account? Tell me. How much money is still unutilized? Out of 2 lakh, we utilized only 1,75,000. 25,000 is still unutilized. This 25,000 will be taxed as LTCG. By LTCG, my original gains were LTCG. Even this will be taxed as LTCG. It will be taxed as LTCG in which year? Which year is this? This is previous year, 24-25. Now, is everybody clear with the capital gains deposit account part? Yes. If you're going to acquire the new asset after your income tax return date, then on or before your income tax return date, you're supposed to deposit money into capital gains deposit account. Whatever you transfer into capital gains deposit account, that much exemption you will get. So how much exemption my assessee will enjoy? 2 lakh he put into capital gains deposit account. This much section 54 exemption he will enjoy in a current year. Okay, we will revisit this account only after 3 years. After 3 years, how much ever money is still left in this account, the unutilized money will now be taxed as LTCG in the year in which the 3 years period comes to an end. Did we all understand section 54? Shall I close section 54? Yes. Now, shall we go to the next section, guys? So let's go to the second exemption section. Our second exemption section is going to be section 54B. Okay, let us try to understand this equally well. We will try to understand this. What happens in section 54B? Here, who is my assessee? Even over here, my assessee is an individual or HUF. What is a capital asset that he has transferred? He has transferred an urban agricultural land. It should be an urban land, agricultural land. Agricultural land means for at least how many years it must have been used for agricultural purposes. At least 2 years it must have been used for agricultural purposes. Then what is my assessee doing with the money? What is he buying? Oh wait, what kind of capital gains has he earned? It doesn't matter. It may be long-term capital gain or it may be short-term capital gain. In section 54, what kind of capital gains we spoke about? In section 54, we spoke about only long-term capital gains. 54B may be long-term or short-term capital gain. And what is he buying with this money? He is buying any agricultural land, which means he may buy urban agricultural land or he may buy rural agricultural land. What is the time limit? Within how much time is he going to buy the land? He's going to buy the land from the date of transfer. I will give him 2 years time to buy the land. This new asset which he is buying, what is the lock-in period for this new asset? The lock-in period will be 3 years. In this 3 years, what should he not do? In this 3 years, he should not sell. But what if he does a violation of this lock-in period? What if he does a violation? Violation means what if he's selling it in less than 3 years? If he sells an agricultural land in less than 3 years, obviously capital gains will arise. To find capital gains, you need cost of acquisition. How will you calculate cost of acquisition? From the actual cost of acquisition, you will subtract the 54B exemption which you had enjoyed already. Very, very similar to what we spoke about under section 54. But tell me, this lock-in period concept will not apply to which asset? It will not apply to rural agricultural land. Why will it not apply to rural agricultural land? Because rural agricultural land, even if I do a violation, will you have any capital gains, guys? Come on, tell me. Rural agricultural land, even if I do a violation, will you have any capital gains? You will not have any capital gains because it's anyways not a capital asset. So that is why this lock-in period point is not applicable to rural agricultural land. Till here you understood? So my assessee is an individual or HUF. Individual or HUF, same like what we learned even under section, same like what we spoke about under section 54. But it should be long-term or short-term. But under 54, it was only long-term. So here I am transferring an urban agricultural land. And what am I buying? I am buying any agricultural land. Then am I buying? I am buying within 2 years from the date of transfer. This new land I should keep with me for at least 3 years. In this 3 years, I should not sell away this land. In this 3 years, if I sell away the land, then there's a violation. Then from the cost of acquisition, we will subtract whatever 54B exemption I had enjoyed already. Even over here, guys, capital gains deposit account will apply. When will you ask your assessee to put money into capital gains deposit account? If your assessee is going to acquire the new agricultural land, when? If he's going to acquire the new agricultural land after 139(1) date, then we will ask him to put money into capital gains deposit account. Whatever money he puts into capital gains deposit account, we will give him section 54 exemption. Right? Then from the date of transfer, when will we revisit the account? After how many years? We will revisit the account after 2 years. We will see how much money is still remaining unutilized on this date. On this date, this unutilized amount, we will tax at what? We will tax it as LTCG or STCG depending upon the original capital gains. Understood? Capital gains deposit account, very similar to what we learned under section 54. We will revisit this account after 2 years. We will see how much money is still remaining unutilized in this account. Please remember, guys, all this 2 years, 3 years and all, you calculate always from the date of transfer. You will not calculate this from the date on which you're transferring money into capital gains deposit account. Even here, if you remember, we calculated from the date of transfer. We will not calculate from the date on which we're transferring money into CGD account. Did you notice that? Yes, we will calculate from the date on which we transferred money into CGD. We will calculate from the date of transfer. When did we transfer the asset? From the date of transfer of the asset, we will add 2 years. Okay, so this unutilized money will be taxed as LTCG or STCG depending upon my original capital gains. 54B clear? Everybody? Yes, I'll take you to the next discussion now, 54D. Come on, guys. Let us go to the next exemption section, section 54D. In 54D, who is my assessee? Here my assessee can be any assessee, not necessarily individual or HUF. In section 54, only individual or HUF. 54B, only individual or HUF. 54D, assessee can be any assessee. Here, what is a capital asset that is being transferred? The capital asset that is being transferred is land or building which was used for industrial undertaking. Land or building which was used as industrial undertaking. Used as industrial undertaking means how many years it must have been used for industrial undertaking? At least 2 years it must have been used for industrial undertaking. This capital asset is being transferred. How is it being transferred? What is the mode of transfer? The mode of transfer is compulsory acquisition. Okay, what kind of capital gains? The capital gains may be any capital gains, long-term or short-term capital gains, same like which other section? Same like section 54B. Section 54 talks about only long-term. 54B also talks about long-term and short-term. Right, guys? So assessee may be any assessee. He is transferring land or building which is a part of industrial undertaking, which was used as an industrial undertaking for at least 2 years. The transfer is happening by way of compulsory acquisition. The capital gain may be long-term or short-term, doesn't matter. What is the new asset that he is acquiring? My assessee is acquiring again another land or building which my assessee is going to be using for industrial undertaking purposes. What is the time limit? Within how much time will you ask him to acquire? You will see what is the date of transfer. From the date of transfer, we will give him 3 years to acquire. Now, this new asset, what is the lock-in period? How long are you supposed to keep this new asset for? Lock-in period will be 3 years. In this 3 years period, what should you not do? You should not sell away within this 3 years period. Then coming to the next point, what if there is a violation? If there's going to be a violation, then there will be capital gains. You're selling away new asset in less than 3 years. You're selling away a capital asset. You will have capital gains. To compute capital gains, you need cost of acquisition. From the actual cost of acquisition, what will we subtract? From the actual cost of acquisition, we will subtract the section 54D exemption, which we already enjoyed. Only the balance number we will take. Understood this, guys? Even over here, we will have capital gains deposit account. But when will this apply? If my assessee is going to acquire the new asset after the return date, only then my assessee will have to put money into CGD account. Whatever money he puts into CGD account, that money I will give him section 54D exemption. Tell me, when will we revisit this account? When will we revisit this account? From the date of transfer, within 3 years, after 3 years are over, we will revisit this account. On this date, whatever money is still remaining unutilized in this account, this money we will tax as LTCG or STCG depending upon the original capital gains. Now listen guys, whenever you have any compulsory acquisition case, whenever you have an insurance compensation case, whenever you have a liquidation case, whenever you have a conversion of capital asset into stock in trade, whenever you have section 4.5 5A case, what is common in them all? Tell me. What is common in all of them? In all of these cases, what is common? Date of transfer, year of transfer, and year of taxation are not the same. Do you agree? Are you able to identify? Yes, guys, in all these 5 cases, year of transfer and year of acquisition are not the same. General rule does not apply here. In these cases, the time limit you will calculate from when? In these cases, time limits you will not calculate from the date of transfer. Like compulsory acquisition cases, you will calculate from the date of receipt of compensation. Insurance compensation cases also from the date of receipt of compensation. Liquidation cases from the date of distribution. Compulsory conversion cases from the date of sale of stock in trade. Basically, whenever you tax the capital gains, from that date you will calculate the time limit. So here it is compulsory acquisition, guys. So will you calculate 3 years from date of transfer? No. In compulsory acquisition cases, when do you tax the capital gains? Only when you receive the compensation. So you will see the date of receipt of compensation. From that, you will calculate 3 years. You understood? In all these cases, you will calculate the time limit not from the date of transfer. In all these cases, you will calculate the time limit only from the date of receipt of compensation. Is this crystal clear to everybody? Yes, this was section 54D. Now let me take you to our next exemption section, section 54EC. Section 54EC, when does this apply? Here, who is my assessee? Here my assessee may be any assessee, same like section 54D. In 54, individual HUF. 54B, individual HUF. 54D, 54EC, any assessee. This assessee is transferring which capital asset? He is transferring any land or building. Movable. It may be residential, commercial, land or building. Maybe just a moment, guys. Listen. So the capital asset may be land or building, can also be a vacant land. It has to be just some immovable property. Okay. And what kind of capital gains is arising out of transfer of this property? It should be only long-term capital gain. Only long-term capital gain. Same like which section? Same like section 54. 54B we talk about any capital gain. 54D we talk about any capital gain. 54 and 54EC only long-term capital gain. What is the new asset that my assessee is buying? My assessee may buy either NHAI bonds or my assessee may buy REC bonds. But total put together in current year plus next year put together, maximum how much my assessee can buy? Only 50 lakh rupees. Okay, what is the time limit? When should this be purchased? This should be purchased from the date of transfer. Within 6 months, it should be purchased. This new asset, what is a lock-in period? Guys, 54EC, think and tell me. Lock-in period is going to be 5 years, right? In this 5 years, what you should not do? In this 5 years, you should not sell away the bonds. Also in this 5 years, you should not convert into money. All the other cases we said you should not sell. You should not sell. You should not sell. But in 54EC, we say you should not sell. Also, you should not convert into money. Not convert into money means what? You should not give these bonds as security and get a loan. You should not convert them into money. Also, you should not sell away the bonds. What if I do a violation? See, generally, whenever I do a violation, what do? Generally, whenever I do a violation, from the cost of acquisition, you reduce the exemption. But here, will I touch the cost of acquisition? No. In case I do a violation here, then whatever exemption I enjoyed earlier, that exemption will now be taxed as LTCG. Are we all following this discussion, guys? Yes, lock-in period is going to be 5 years. In this 5 years period, I should not sell away. Also in this 5 years, I should not convert it into money. In case there is a violation means I sold it off in less than 5 years or I converted into money in less than 5 years, then whatever exemption I have enjoyed already, that exemption will now be taxed as LTCG. All right, here tell me, will capital gains deposit account apply? No concept of CGDS. Understood, guys? Guys, one more small thing. Here, when will we revisit the account? In 54D, will we revisit the account from the date of transfer? All compulsory acquisition cases, we don't take date of transfer. Instead of date of transfer, what will we take? Date of receipt. So not the date of transfer. Here we will revisit only 3 years after date of receipt. Okay, so in these cases, we will not consider date of transfer. Instead of date of transfer, we will consider the date of receipt of compensation. So even 3 years time limit will start from the date of receipt of compensation. When will we revisit CGD account? Only 3 years from date of receipt of compensation. Okay, 54EC, my assessee is any assessee. Capital asset should be land or building. Capital gains should be long-term capital gains. New asset acquired should be NHAI bonds or REC bonds, but maximum 50 lakhs only current year and next year put together. No capital gains deposit account. Acquire the new asset within 6 months. New asset you have to keep with yourself for 5 years. Generally, all the sections you had to keep lock-in period only 3 years. Here only lock-in period 5 years. Okay, and in this 5 years, you should not convert it into money. This is a special point here. In case as a violation, whatever exemption you enjoyed earlier, it will now be taxed as LTCG. Now coming to our next classic section, one of the most important sections in your entire capital gains chapter, section 54F. What do you do in section 54F? Who is my assessee? My assessee is an individual or HUF. Same like which other section? Same like section 54. Same like section 54B. That's it. 54D. any assessee. 54 EC, any assessee. So 54F, 54 and 54B only individual or HUF. What is a capital asset he's transferring? He's transferring any capital asset, but it should not be what? It should not be residential house property. It should be any capital asset, but not residential house property. And what kind of capital gains is he earning? Long-term capital gains. Long-term capital gains, guys, same like which other asset? Same like which other section? Section 54, then section 54 EC. 54, 54 EC and 54F, they talk only about LTCG. What is the new asset that he is buying? He is buying residential house property. Where? He is buying residential house property in India. Even over here, do you have any limit on how many residential houses? Yes, even over here, only one. But do I have once in lifetime up to 2 crores, 2 properties allowed? Do I have that here? That's only in section 54. Okay, then what's the time limit? When am I going to purchase? It depends. If I'm going to purchase, how much time do I get? From the date of transfer, 1 year before transfer or 2 years after transfer. If I'm going to construct, then from the date of transfer, within 3 years, I must do what? Within 3 years, I must complete the construction. Okay, so my assessee is an individual or HUF. He's transferring any long-term capital asset which is not a residential house property, and he's getting long-term capital gains, and he's buying one residential house property in India. My assessee, there are some extra points here on the date of transfer. On the date of transfer, in addition to the new property, how many maximum residential house properties my assessee can own? In addition to this new property, on the date of transfer, maximum one property only my assessee can own. Okay, here this new asset, what's the lock-in period? Tell me. Lock-in period here will be 3 years. 3 years only. 5 years only in 54 EC. Okay, in this 3 years, what I should not do? In this 3 years, I should not sell. Only one point. You should not convert into money. That point also is only in 54 EC. 54 EC lock-in period is special point. Okay, then what if there is a violation? What if I do a violation? Then will I touch the cost of acquisition? No. If I do a violation, then whatever capital gain was exempt earlier, that will now be taxed as LTCG, same like section 54 EC. Okay, so in the 3 years period, I should not sell. If I sell in 3 years period, I will not touch the cost of acquisition. In the 3 years period, if I sell, then whatever capital gain was exempt earlier will now be taxed as LTCG. Now tell me, even over here, capital gains deposit account will apply, guys. Yes, when will capital gains deposit account apply? If my assessee is going to acquire the new asset only after section 139(1) date, only then capital gains deposit account will apply. If capital gains deposit account applies, whatever money he puts into capital gains deposit account, that exemption you will get. When will you revisit the account? From the date of transfer of the capital asset, after 3 years, you will revisit the account. Whatever money is unutilized, that unutilized money will now be taxed as LTCG. Okay, now listen. In section 54F, you have a unique method of calculating the exemption. In all the other sections, what amount do I want you to invest in the new asset? In all the other sections, I want you to invest the capital gains number in the new asset. But in 54F, what do I want you to expect? What do I want you to invest? The net consideration number. In 54F, if you invest the net consideration number in the new house, then how much exemption will you get? In that case, your entire LTCG exemption you will get. So if you invest lesser than net consideration, then exemption also will be lesser number. So what will the exemption be? The exemption will be whatever amount you have invested in the new asset into your LTCG number divided by your net consideration number. Your exemption will be whatever amount you have invested. So which means, guys, when will my entire LTCG be exempt? My entire LTCG will be exempt only if I invested the entire net consideration number. Do you all agree with this? Yes, my entire LTCG will be exempt only if I invested the entire net consideration number. If I invest less than net consideration number, then only less than the total LTCG will be exempt for me. This is unique only and only in section 54F. What is the exemption? Amount invested into LTCG by net consideration. This is how you will calculate the exemption. If that is the case, if you have unutilized amount, will this unutilized amount be fully taxed as LTCG? No. CGD account, you transferred money into CGD account because you wanted to acquire the new asset after 139(1) due date. When will we revisit the account? From the date of transfer, after 3 years are over, we will revisit the account. When we revisit the account, we will see how much money is unutilized. That unutilized money, I can't straight away tax as LTCG. How much will I tax as LTCG? I will see the unutilized amount into LTCG by net consideration. This amount I will tax as LTCG. Same thing, instead of amount invested, unutilized amount. I will see how much money is unutilized, that into LTCG by net consideration. That is what I will tax as LTCG. Got it, guys? This is section 54. Crystal clear with this discussion as well? Yes. Any confusion? Anywhere do you need examples? Able to grasp? 54F you understood? 54F is nothing but my assessee is an individual or HUF. He has transferred any capital asset which is not a residential house property, and let us say he has acquired a new residential house property in India. Long-term capital gains he is having. New asset lock-in period 3 years. In this 3 years, don't sell away the property. In case you do a violation, whatever exemption you enjoyed earlier will now be taxed as LTCG. Then we learn time limit. If you're purchase 1 year before transfer or 2 years after transfer. If you're constructing, complete the construction within 3 years from transfer. Then we learned that you will also have to put, in case you're going to buy the new asset after 139(1) date, then you'll have to put the money into capital gains deposit account. Whatever money you put into capital gains deposit account, that money you will get as exemption on the basis of this formula. We will revisit this account after 3 years. After 3 years, whatever money is unutilized using this formula, it will be taxed as LTCG. See, I'll give you one example, okay? Listen to me. Let us say net consideration was 200 rupees. Less index cost of acquisition was, let us say, 150 rupees. So what is my LTCG? LTCG is 50 rupees. Okay. In my, I'll give you 2 examples. In my first example, I'm talking about previous year 21-22. Let us say the applicable 139(1) date was 31st July 2022. And we purchased the new asset. We purchased the new asset for let us say 75 rupees. We purchased the new asset. We purchased this asset within 31st July itself. Let us say we purchased it on 30th July 2022 itself. So what will be the section 54F exemption? How will you calculate? What is, first of all, do we need capital gains deposit account? Tell me. Do we need capital gains deposit account? No, right? We are purchasing within 139(1) due date. I don't need capital gains deposit account. So what will be the section 54 exemption? We will see what is the amount invested in the new asset into what's the LTCG? 50 divided by net consideration 200. Right? So 75 into 50 by 200, 18.75. This is going to be the 54F exemption. Do you all agree with this calculation? Amount invested in the new asset into LTCG by net consideration. This will be the 54F exemption. This new asset I'm supposed to keep with me for how many years? For 3 years. Let us say I sold within 3 years. Then what will you do? If I sold within 3 years, then this amount you will tax as LTCG in the year of violation. Right? See, if I sell it in less than 3 years, for that sale, capital gains will anyways arise. In addition to that capital gains, whatever exemption I enjoyed earlier will now be taxed as LTCG. Comfortable till here? Now listen to my second example. In my second example, my assessee wanted to make the purchase only after 139(1) due date. So what will you suggest to the assessee? You will suggest to the assessee put money into capital gains deposit account. Capital gains deposit account on 30th July 2022, he put 75 rupees. So how much section 54F exemption you will give? The same number will be the 54F exemption. Same 18.75, you will give us 54F exemption. Okay. Now tell me, out of 75 rupees, let us say my assessee has used only 60 rupees. Tell me, when will you revisit this account? From the date, let us say the date of transfer was 1st January 2022. So when will you revisit the account? When will you revisit the account? You will revisit the account 1st January 2022 plus 3 years. That's going to be 1st January 2025. 1st January 2025, how much money is still remaining unutilized in the account? Tell me. Out of 75, you used 60. So how much money is remaining unutilized in the account? 15 rupees is still remaining unutilized in the account, right? So how much will be taxed as LTCG now? Amount remaining unutilized into LTCG, which is 50, by net consideration, which is 200. What does this, how much does this work out to? 15 into 50 by 200, 3.75. This much will be taxed as LTCG when? When do the 3 years period get over? Previous year, 24, 25. Now comfortable, everybody? Now I think you will all be having better understanding, right? So we will revisit this account after 3 years are over. In after 3 years, whatever money is remaining unutilized amount into LTCG by net consideration, this much I will now tax as LTCG. Okay, guys, so this is it with all our exemption sections. See, in exemption sections, I'll tell you where exactly students go wrong. Now, when we are revising on CGDA, you're telling me correctly. Okay, you're telling me correctly about CGDA. But in the examination, students don't even think about CGDA. They only think about the time limits. That is why I want you to do one thing. Whenever you do the exemption calculations, before exemption calculations, pause and check, was CGDA even required? Pause and check whether CGDA even required or not. Only then do the calculation. If CGDA is required, you should make sure money was transferred within 139(1) due date into CGDA. Only then you give the exemption. You're understanding? Don't blindly calculate the exemption. Just because the new asset was purchased within the time limit, don't blindly calculate the exemption. In case you are making the purchase after 139(1) date, CGDA is required. So guys, keep this as a thumb rule. Whenever you do exemption, before you do exemption, always pause, check is CGD required or not. Will you keep that in your mind? Okay, so this is it about our entire discussion regarding the exemption sections. So we learned about what are the exemption sections we have learned about. We have learned about section 54B, 54. We spoke about 54B, 54D, and 54EC, and then we spoke about 54F. In 54, I am selling away residential house property, I am buying another residential house property. 54B, I am selling urban agricultural land, I am buying any agricultural land. 54D, my land or building for industrial undertaking is getting compulsorily acquired and I am buying another land or building for industrial undertaking. 54EC, I am selling any long-term land or building, I am buying bonds. 54F, any long-term capital asset other than house property I am selling and I am buying one residential house property in India. Okay, now listen to my next discussion. By the way, tell me, can I sell away, can I enjoy 2 exemptions for the same transfer? Like for the same transfer, can I enjoy 54, like for example, I sold away an urban agricultural land, okay? I purchased rural agricultural land also, I purchased residential house property also. So will you give me 54B exemption and 54F exemption? Yes, it is allowed. Yes, guys, it's allowed. I have sold away an asset and I purchased 2 assets. I sold urban agricultural land and I bought rural agricultural land. So you'll give me 54B exemption. I purchased land, I purchased residential house property also. So you'll give me 54F exemption also. So same asset sold, 1 asset sold, 2 assets purchased. You can give me multiple exemptions. But can you have a negative number because of exemptions? You can't have a negative number because of exemptions. Okay, now listen guys, we are going to the last part of our discussion. We're going to be learning about taxation of capital gains. How do we tax capital gains? It depends upon whether my capital gains are short-term capital gains or long-term capital gains. If they are short-term capital gains, they will either fit under 111A or they will be taxed as per normal rates. If they are long-term capital gains, they will either be taxed under section 112 or they will be taxed under section 112A. So we have to learn just 3 sections now, section 111A, section 112 and section 112A. All right. Now listen, our first discussion is going to be about section 111A. When do you apply section 111A? We will go carefully. We'll go point by point. Slowly we will go. 111A will apply, number one, only to short term, but it will not apply to every short term capital asset, because short term capital asset will either come under 111A or normal rate. When will it come under 111A? Only if the short term capital asset is either listed equity shares or listed, come on guys, tell me, listed units of equity oriented mutual fund or listed units of business trust. And for all the three, we should have paid STT. When we should have paid STT? At the time of transfer, we should have paid STT. Okay, so point number one, short-term capital asset, listed equity shares or listed units of equity-oriented fund or listed units of business trust. For these assets, section 111A will apply. Under section 111A, what will be the tax rate? The capital gains will be taxed at what rate? They will be taxed at 15%. So this becomes a special rate income. Okay, again, special rate income can be utilized unutilized BEL. Can we utilize unutilized BEL against section 111A STCG? Yes or no? I have unutilized BEL. Can I utilize against 111A? Yes, I can apply. But what is the condition? Only if my assessee is a resident assessee. Only if my assessee is a resident assessee, then unutilized BEL, I can adjust against 111A FTCG. Then tell me, against 111A income, can I claim Chapter 6A deductions? Chapter 6A? Not allowed. But can I claim Section 87A rebate? Section 87 rebate, can I claim? Yes, I can claim. Okay, this was 111A. I am transferring listed equity shares or listed units of equity-oriented mutual fund or listed units of business trust. FTT I am paying at the time of transfer. What will the tax rate be? 15%. Is everybody clear with 111A, guys? Yes. So if the capital asset, if the short-term capital asset is any of these three, then it will come into 111A. All other short-term capital assets will go where? All other short-term capital assets, just like any other normal rate income. All right, guys. Now listen to my next section, section 112A. Section 112A will apply to long-term capital asset. It should be what long-term capital asset? It should be either same thing, same three assets, guys. Listed equity shares or listed units of equity-oriented mutual fund, listed units of business trust. But when should you be paying STT? For listed equity shares, you must be paying STT. When STT, you must be paying on the date of acquisition also. You must be paying STT on the date of transfer also, both. But listed units of equity-oriented mutual fund and listed units of business trust, it is enough if you paid STT on the date of transfer. Okay, now listen, even for listed equity shares, STT on the date of transfer, STT on the date of acquisition is not required when? Does anybody know this? Even for listed equity shares, STT on the date of acquisition is not required when? If the date of acquisition is before 1st October 2004. Before 1st October 2004, STT did not even exist. So if you acquired before 1st October 2004, you do not need any STT on the date of acquisition. Also, if they are bonus shares, if they are sweat equity shares, if they're bonus shares, sweat equity shares, rights shares and all, company is directly giving you these shares. You are not buying the shares through stock exchange. We pay STT only when we buy the shares through stock exchange. Okay. So if they're bonus shares, sweat equity shares, rights shares, company is directly giving you the shares, not through stock exchange. In such cases, you don't need STT on the date of acquisition. Is this point clear? Okay. This is my first point about long-term capital asset. Under section 112, what is the tax rate? At what rate do you tax the LTCG? You tax the LTCG at the rate of 10%. But how much exemption do you enjoy? You enjoy an exemption of 1 lakh rupees. But tell me, when do you enjoy this exemption? In the total income calculation, do you enjoy any exemption? No. Total income computation, you will take the entire number. When will you enjoy the exemption? Only when you do the tax computation, only at that time you will think about this exemption. Okay, guys, come on, guys. Last part of the discussion. At this point, you can't get tired. Okay, come on, show in some effort, little bit more effort. Let us push. Come on, guys. Exemption 1 lakh rupees we will get. When will we think about this exemption? We will think about this exemption only when we are going to do tax computation, total income computation and all. We will take the entire LTCG number. Then it is long term. So can I give indexation benefit? No. 112A cases, even though long term, we do not give any indexation benefit at all. Okay, section 112 will apply only if the date of transfer is on or after 1st April 2018. In case I have any unutilized BEL, this unutilized BEL, can I adjust against 112A LTCG? Am I allowed to adjust? Yes, but only if my assessee is a resident assessee. Then, will I get Chapter 6A deduction, guys? Chapter 6A deduction, will I get? No. Will I get 87A rebate? No. This is the only income in the entire Income Tax Act. This is the only income against which we do not get 87A rebate. Okay, then coming to one last point, in case the date of acquisition is on or before what date? In case date of acquisition is on or before 31st Jan 2018, then what will the cost of acquisition be? You will compare the actual cost of acquisition with what? With FMV on 31st Jan 2018 or FPC. These two numbers you will pick whichever is lesser. These two numbers you will pick whichever is higher. Only if the date of acquisition is before 31st Jan 2018. If the date of acquisition is after 31st Jan 2018, take the actual cost of acquisition. Okay, so this is it about section 112A. Section 112A, it will apply only if my long-term capital asset is listed equity shares, listed units of equity-oriented mutual fund, listed units of business trust. I should have paid STT on date of transfer for sure. Date of acquisition also I should have paid STT for listed equity shares. But even listed equity shares, STT not required on date of transfer if they were acquired before 1st October 2004. Bonus shares, rights shares, sweat equity shares. If I did not acquire through STT, basically, see, actually speaking, 112A applies only if you acquired the shares through stock exchange. Okay, but in these cases alone, you have an exemption. All right, if you did not acquire the shares through stock exchange, 112A will not even apply. 112A will apply only if you acquired the share through stock exchange, because only if you acquire the share through stock exchange, only then you would have paid STT at the time of acquisition. Only these 4 exemptions you have. If you acquired before 1st October 2004, bonus shares, rights shares, sweat equity shares, here alone STT not required on the date of acquisition. Otherwise, if you, like for example, if I purchased shares from my friend, did I purchase through stock exchange? No. I wouldn't have paid STT. So this condition is not fulfilled. So 112 will not apply. 112A, I should have purchased shares through stock exchange, because only if I purchased through stock exchange, I would have paid STT at the date of on the date of acquisition. But this point is not applicable only and only in these cases. If I acquired before 1st October 2004, bonus shares, sweat equity shares, and rights shares. Okay, tax rate will be 10%. I'll get an exemption of 1 lakh, but only at the time of tax computation. No indexation benefit. Date of transfer should be on or after 1st April 2018. Only then 112 will apply. Unutilized BEL, I can utilize, but only for resident assessees. No Chapter 6A, no 87A rebate, cost of acquisition, special calculation. Now listen, in 111A STCG, what is a maximum surcharge rate? Surcharge maximum 15%. Okay, in 112A, even here, surcharge maximum 15%. Okay, now listen. Section 112. When does section 112 apply? When does section 112 apply? Section 112 apply to all other, if I have a long-term capital asset to which section 112A is not applicable, then I will apply section 112. Okay, here what will be the tax rate? Here the tax rate will be 20%. But in case my long-term capital asset happens to be listed equity shares, Or in case, or not listed equity shares, I would say listed securities. Or in case my long-term capital asset happens to be zero coupon bonds, then I have two options for these two. What are my two options? Option 1, option 2. Option 1 is they can pay 20% tax and they can also enjoy indexation benefit. Option 2, they can pay 10% tax, but then they'll have to give up indexation benefit. Okay, then tell me, if I have any unutilized BEL, can I adjust that against section 112 LTCG? Yes, but only if my assessee is a resident. Then tell me, is chapter 6A deduction available? No. Is section 87A rebate available? Yes. Here tell me, what will the surcharge rate be? Come on guys. Here surcharge rate can be maximum 37%. Maximum 15% is not applicable in 112 for your examination. May 2023 onwards, there's an amendment. May 2023 students, if you are watching this session, for May 2023, even here surcharge maximum 15%. Okay, but November 2022 students, surcharge maximum 37% in 112. All right, guys. So that is it. With this, we come to an end. One last thing, let me tell you. Always remember, guys, once you compute gross total income, after you compute, don't straight away subtract chapter 6A. Split this into special rate income, split this into normal rate income. Why? Because again, special rate income, can you subtract chapter 6A? No. Chapter 6A, you will subtract only against normal rate income. Okay, so do this as one standard thumb rule. GTI split into special rate and normal rate, and subtract chapter 6A only and only against normal rate incomes. Will you remember this? Okay, so all the tax calculations fine, section 111A, 112A and 112. Okay, I hope now you're feeling a little better with these two chapters of PGBP and capital gains. Right guys, see, even the day before the examination, if you're going to be doing the revision on your own, it will take you a lot of time. So you can simply watch this video. I will put this video up also on my YouTube channel. Okay, so you can simply watch these two videos the day before the examination. Quickly, you will be able to finish off these two chapters. All right, once you finish off these two chapters, I'm very sure you would have marked and kept some questions which you want to work out the day before the examination. The provisions part, at least revision will get done fast through these two videos. So 4 hours for PGBP, 4 hours for capital gains, entire revision you will be done. In fact, day before the examination, if you're watching, you can watch even at 1.5x speed, you will get done even faster. All right, guys. Yes, so now with this, we come to an end to our session. Go out there and do the best that you can. How many days are you left with? Around 10 to 12 days you're left with. Even Diwali comes in between. I know Diwali is going to distract you. Try your best to, keep that distraction at bay. Okay, do not let the festival season disturb you. All right, it is very, very common that November exam students get affected by Diwali. I remember my own CA final examination was next day after Diwali. Okay, and it was crazy. And I remember everybody else was out there, but I was locked in my room. I could hear crackers all around, but I was locked in my room and I was doing my work. I had put on my headphones so that, no noise was coming in from anywhere, no cracker disturbance, nothing. I put on my earphones, I closed my windows, I turned on the AC, no noise from outside coming in, and I was sitting and studying. So put in that effort, guys, put in that sort of effort, you will be able to ace it. All right, so I'll close over here. I'll put up the video. I think by tomorrow morning, you will get it on the YouTube channel. Thank you, guys. Bye-bye.